Equity markets this morning, if the yen reaction this morning is anything to go by, we are all obsessed with now what happens with the Fed. That is the narrative. We'll see exactly how European Open, the Open goes this morning. I don't think you're going to see fireworks in much this morning. At a headline level, it's a single stock story. So initially out of the gate, the FTSE 100 just drifting a little bit lower, but nothing really significant. We'll see whether we get some reaction to the Nvidia name checking of yesterday, and whether or not that shows up in the market this morning. Schneider Electric is one name that certainly stands out on that front, and whether or not we get a reaction in ASML, but you didn't see that reaction in terms of the Nvidia stock. So Unilever is in terms of the points gains this morning, Unilever's up there right at the top. Ice cream is important. Airbus, to your point, is also rising on the back of that. Then you've got some of the commodity stocks as well. So Rio's tracking a little bit higher this morning. Total is tracking a little bit higher as well. Chips and luxury. And Astra, actually, is where the softness is.
Yes, and ice cream is where the strength is. I'm just looking at some research from the Bloomberg intelligence team on that Unilever subject, talking about how it's planned to separate out its ice cream unit for probable divestiture. We shouldn't get ahead of ourselves, should we? Removing seasonality from the growth and a low margin drag. So there's two reasons.
People only eat ice cream in the summer?
I mean, this is new to me.
I know, precisely.
I think I'm going to be in the camp where ice cream isn't all year long.
Yeah, but clearly not. That's what they're saying. They want to remove the seasonality.
Perhaps I'm in the minority of that. We should also bring up the fact that ASML is actually one of your biggest weights in early trading on the Stock 600 here. Of course, we don't have the full trades coming out yet. At the same time, NVIDIA down 1% in pre-market trading over in the States, which, by the way, opening as well at the same time, just given the time difference here. There's a tech theme going on both sides of the Atlantic, basically trading lower this morning.
The theme to me looks like it's growth stocks coming off. So ASML is softer, LVMH is softer, Astra's down, Richemont is a little bit softer as well. It's interesting that UBS on this important day is also a little bit softer, but not by much.
Yeah, and the real strength, to your point earlier, Guy, is coming from personal consumer goods, grocery stores. So that's the Unilever effect. That sector is up the most. It's up by 1.1% this morning. We've got a few sectors higher, but that is the best performing. And Unilever, the best performing stock within that, up by 4.8%. Reckitt Benckiser, on the other hand, still suffering from all of that negative news flow around that business. That stock is down by 2% this morning, but around a third of stocks in positive territory.
Yeah.
Sorry, a third of sectors in positive territory this morning.
Yeah.
Can I just mention that Atos, by the way, is halted at the moment? So
So maybe we do get a reaction in there.
Potentially,
But you got a reaction in Airbus. So Airbus is up by 1.9% at the moment. This has been long telegraphed. This has been long anticipated. Maybe not everybody's got the memo, but this has been something that has been talked about for quite some time. It initially was announced with a kind of flurry of expectation. And then basically you got this political pushback. You certainly got this investor pushback that this was not a good deal for Airbus to be doing.
The big market story coming into this European session has really been around the BOJ. And I suppose if you're just joining programming this morning, expecting great fireworks from financial markets as a result of the end of negative interest rates, we haven't got that, have we? We've got a yen that's down 0.7%, to push weaker through 150.
I think that's the firework. It's the move higher in the yen. Sorry, the move higher in dollar yen. So the dollar strengthening tells you about the power of the Fed in this scenario. You've seen other currencies weakening against the dollar going into this Fed move. The BOJ to a certain extent allowing the market now to play catch up. So the fact that we got this kind of slightly counterintuitive reaction in the market, I think, is fascinating. And Ueda's been slightly more hawkish in the press conference than maybe the statement, but the market is still looking at this as a low vol story with a carry that is still on, and therefore the yen continues to be
still
weak.
a lot about accommodative policy for a while.
The FX market is, but then if you look at JGBs, you saw funds flowing into JGBs, and that makes sense, right? Just simply given going into zero yield. But is zero yield a good yield? We don't really know.
It's better than negative.
It's true. Better than negative, but it's not as good as the rest of the world. And
Apparently
that's the point
not.
about carry trade, isn't it? That remains intact as a result. That was certainly the view of one of our guests in the last hour. Let's just throw into the mix some of the commentary we've had from the Bank of Japan Governor Ueda, then speaking a little earlier this morning at the press conference. And crucially, we've been watching the wages story for a long time in Japan. Let's listen to what he had to say on that subject.
At today's meeting, we took a thorough look at the recent economic, financial, and price developments, particularly in wages and prices. The board members determined that recent data and information from hearings, including the current results of spring wage negotiations, have confirmed the strengthening of the virtuous cycle between wages and prices. Therefore, the bank has decided to review its large-scale monetary easing program this time.
Let's get another view on this story. Andrea DiCenso joins us, Vice President and Co-Portfolio Manager at Loomis Sales. Very good to see you, Andrea. Thank you so much for joining us. So, we can spend ages talking about the dynamics of JGBs or the dynamics of the yen this morning, the specifics about how the market is reacting and isn't reacting. From a sort of global perspective, from your portfolio manager perspective, what were you looking for from the BOJ today? And did you get what you were expecting?
I think what they delivered was what they telegraphed, and that's why we're seeing this market reaction of a weaker yen, stronger dollar, carry trade persisting, low volatility persisting, and that's all positive for risk sentiment. So as we look forward from here, we're all looking at the Fed, and will they actually follow through with what the market is anticipating? Now, the interesting point is the market is shifting its expectations around what they are anticipating from the Fed. We are now thinking perhaps we get slightly higher dots. Could we see fewer cuts being priced in? We're seeing for the first time in a while less than potentially 3 cuts priced into the market. So this could be a point of triggering some cross-asset volatility. And now that we have the BOJ out of the way, we can all firmly focus on the Fed.
Okay, we firmly focus on the Fed. And so the expectation is then, do you think we get that volatility from the Fed? Because it seems that the market has been gradually pricing out rate cuts from the Fed over the last 4 months or so. And that's happened without a great deal of volatility.
Yeah, there's been a material price out of cuts. And I think we'll continue to see that. Now, we've had 3 stickier inflation prints, and now we're starting to see headline inflation pick up. I know you've been commenting on commodity prices rising. We're seeing overall commodity complex up roughly 4% on the year, seeing iron ore pick up, copper pick up. Those have larger weights in the overall commodity index and have important implications to headline inflation, which is maybe not as important to the Fed, but important to many emerging market inflation outlooks as we look out the rest of this year. So, yeah, we believe that we could get less than 3 cuts this year, and that has very important implications for what's being priced in right now to, say, high-yield markets, low-quality emerging market corporates and sovereigns at this point.
How much higher can the dollar go in that environment, though?
I think we could see another 3 to 4% higher on the dollar if that was to play out. And, I mean, that would be viewing the 10-year back testing 5% again. So could we see those October 2023 levels retested?
So the 10-year goes to 5?
We could see it. I don't think the market is pricing.
The 10.
The 10.
Yeah.
I don't think the market is pricing that at this point in time. So we could start to see this price momentum pick up again.
In terms of, okay, let's walk through the implications of that. If that continues, does that continue to attract in more flows into US assets? Because at the moment, there's quite a strong relationship between the dollar and forward PEs. Lisa Shallett, Morgan Stanley's been pointing this out. How positive a virtuous cycle is this for US assets if the dollar continues to climb?
That U.S. exceptionalism trade that you're highlighting, I think, will be reignited again, because when we start to see this backup in rates, what we saw were people saying that this backup in rates can't be persistent for a material amount of time. So you start to see buying. Now, The question is, what asset class are they buying into?
Yep.
Is it equities, or are we seeing them buy into duration-sensitive assets? And that's what we believe will be what plays out, because right now, duration-sensitive assets like investment-grade corporates are really the only market pricing in any probability of a recession, i.e. not a perfect landing at this point in time.
Yeah.
So what are we're talking about, we were expecting, I should say, a bigger ripple effect from the BOJ.
Yeah.
We didn't really get that, at least initially. And to be fair, the U.S. isn't quite awake yet, so there could be some sort of bigger shock factor that comes later. The Fed is kind of expected to be a little bit of a nothing burger tomorrow when it comes out. Where is the shock factor then? Is there another central bank around the world that is going to be surprising and is going to be having a bigger ripple effect other than the big ones?
No, I think for now, I mean, you look at many emerging market central banks, they're still firmly on a cutting cycle at this point in time. It really does seem very focused around the Fed. And not just because I'm a U.S.-based investor. I do believe many market participants are looking at the Fed for directionality. And when you think about the implications that the Fed has had across global markets at this point in time, what is being priced in is really a perfect landing scenario, them not even a soft landing, it is a perfect landing.
Yeah.
So that has grown in concern for us. I mean, you look at high yield corporates, their spread over Treasury at the lowest level since 2007. So are you actually being compensated appropriately for any rise in defaults? Should we start to see the U.S. look any weaker than what we're pricing at this moment in time?
Does the macro even matter right now? I'm curious, as an investor or when you're speaking to clients, does the Fed policy, does every kind of word that Chair Powell says have any read-through on the way that the market is trading, which is kind of like that it is a perfect landing, to your point?
I think it will matter as we move forward from here, because there seems to be more confusion around that future path. I mean, when you look back at December 2023, we were pricing in 150 basis points of cuts. That has just been marked lower and lower and lower, and it's really built around the Fed's dialogue of being data dependent. That data does matter. Chair Powell has been very clear he's looking for continued improvement in the inflation data, and that is not what we have received so far. So macro does matter. I would also say China's macro backdrop is going to matter as we think about the second half of this year. We're just starting to see that IP data improve. You're seeing that ignite prices in iron ore and copper. Could that have further follow through? And does the growth differentials shift away from that U.S. exceptionalism trade back towards the rest of the world? And that might have a changing dynamic for the dollar backdrop also.
Yes, it's hard to imagine when the AI theme seems so strong, but yes, worth keeping an eye on, of course. You mentioned earlier low-quality corporates, and that's being an area of concern. We spoke to a guest a week or so ago on corporate credit who was extremely relaxed about the risks around default. Are you more so then? How would you measure your level of concern around default?
I don't have a tremendous amount of agita around the default outlook at this point in time, but I would say it is priced perfectly. So what you need is just the Fed to perfectly thread the needle. Their ability to do so historically has not been so favorable. So I think when you think about opportunities to see some potential volatility in specifically the lower quality tiers of high yield on a global basis, I think it's really ripe for that.
Andrea, we're going to leave it there. Very nice to see you. Thanks for stopping by to see us here in London. Andrea D'Ascencio, on what's happening in these markets. 5% 10-year. That'll certainly shake things up a little bit. Talking of what's happening in the markets right now, I want to focus on what's happening with the sensational six, the core six stocks that we've been watching. Take a look at what is happening here. Some weakness creeping in, certainly some of the luxury names. You got LVMH, Ferrari, both softening up. ASML down, maybe on the back of what we saw in NVIDIA last night. But look at Schneider. It is up a little bit, as is Nestle. Schneider being name-checked once again by NVIDIA yesterday, Jensen Huang. But the real standout story, once again, in the pharma space. Novo Nordisk, up by 0.3%. Some of the big moves in Europe, some of the big stocks moving maybe a little bit in Europe. Where are the bigger moves happening? Let's find out. Joe Easton's got the details.
So we'll take another look at Unilever, up around 5% now. It's one of the best performers on the market today, and that is the biggest gain since May 2022 for that stock. So we can see that stock is a pretty stable one. That gain following news that they will separate their ice cream business and those job cuts and cost savings as well. Over in financials, we've got Partners Group, the massive Swiss private equity firm, reporting a drop in management fees today, and that stock coming down a tad, and a rebound for Close Brothers. This is the UK bank that's been absolutely slammed by the FCA review into motor financing, down about 60% already this year alone, but coming up 15% now. And finally, on the earnings board, we've got the Frankfurt airport operator, a surprising miss on expectations for their earnings today, even as passenger numbers do remain pretty solid. That stock dropping 5% at the moment. We'll take a look at some deals. There's deals news everywhere this morning. AstraZeneca, of course, back in the market, buying Fusion Pharma, $2.4 billion. I've just looked at Fusion Pharma pre-market. It's up around 100% in the US, because that is a 100% premium on where it closed yesterday, almost, for that. So that is a big deal in terms of the smaller cap US farmers. AstraZeneca itself down around 0.7% at the moment. And you were mentioning Atos there. It's in and out of trading halts over in France. Collapsed deal talks with Airbus around the sale of their data business. It was around $1.5 billion potentially. They needed that cash. There was political pressure, and that stock down 18%. We had ThyssenKrupp, because they were also in the deal news, weighing a partial sale of their marine unit to Carlyle, but that one pretty steady at the moment. And Moncler seeing a big share placing, €67 a piece. That is at a discount. It's coming down 2% at 67.68. A big holder dumping some stock there. We need to talk about Swiss watches, because we've seen a drop in Swiss watch exports, according to later today, down around 4% according to this data. Still at around 4 billion in terms of the quarterly sales of Swiss watches, so it's pretty good numbers, but that is an unexpected decline, and as such, seeing weakness in Swatch, Richemont, and also the UK retailer Watches Switzerland. But these two here among the worst performers on the Swiss market because of this data this morning. In terms of a couple of broker moves, Morgan Stanley has a big note out today on recruitment stocks, warning of a potential slow recovery in the staffing market. We've seen profit warnings there. They go underweight on Adecco, the big Swiss firm, also over in Switzerland. That one down around 0.4%. And you mentioned Airbus. There is the Atos news, but also we've got an upgrade for them over at RBC today, who say that the company is making progress in narrow-body, short-haul jets, stealing market share from Boeing, and also their engine production issues are easing. That one gets an upgrade to outperform at RBC, and we're up 1.6% for Airbus.
Joe Easton from our equities team, we thank you so much. I've got to say, I love that watches board. It was fascinating. I didn't realize watch data could impact the entire benchmark in Switzerland. Learning so much this morning. Coming up on the program, we learn a little bit more. NVIDIA unveiling the successor to its all-conquering AI processor. More on the market's muted response to CEO Jensen Huang's highly anticipated speech. That coming up next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking. and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
From the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurise the handle. The gel flows through the reservoir up to the head of the razor, coating the blade, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September with copyright protection. I have a logo for the Gel Razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
in that initial speech. I'm curious about the read-through. A question we keep asking a lot of market participants is, how do you play the NVIDIA story outside of NVIDIA stock? Talk to us about the ripple effects of NVIDIA. I feel like the message yesterday was NVIDIA, AI, chips, touches a little bit of everything.
Yeah, there was, I mean, look, there were lots of companies. They name dropped everyone from, as you would expect, the hyperscalers, the big cloud companies like, you know, Google, Microsoft, Amazon, Oracle to an extent. They all got a big shout out. We also saw some of the more like industrial players, names like Siemens and Hyundai, heavy industry. They got a shout out. Now, I think it's really NVIDIA trying to make the case that they are sort of finagling their way into every part of the real economy. And what was really fascinating as well was the way they were talking a lot about the software, right? It's not just the hardware. And that, of course, helps build stickiness. So when we think about the ability of others to play in the space, it's going to be even harder to compete with NVIDIA, not just because their chips are getting better, but also because they are really getting their claws into a lot of the companies where they're providing services, because there's that increased pairing of the software piece and the hardware piece. And so it's hard to see how anyone directly competes just yet. We're seeing increasing movement from AMD, but it's tiny in comparison to what NVIDIA is doing. But it's all these other players who are starting to ride the AI wave, and of course, I'm super keen to talk about it.
So we've met the Blackwell new chip, Alex. We've been introduced to a number of cute and not so cute robots on stage. This is only day one of this 4-day developer conference. What's left to find out about NVIDIA this week?
To be honest, actually, a lot of these conferences, it's the same with like Apple's WWDC, which happens in June. That's their developers conference. A lot of it's actually really in the weeds. You have these little seminars where people will learn how to do very distinct processes with the technology offering. So there's not necessarily much more that's kind of for us, perhaps the more general interest audience. It's now really for the developers to dig in, find ways that they can, you know, put these products into their services. It's, you know, important for them, and it is that way that NVIDIA like gets its way into under the skin of other companies by showing everything they're able to do, but it is very much in the weeds.
Alex, when does this, you talked a moment ago about kind of the ripple effect. Anna was addressing some of the companies that were name-checked yesterday. When does the NVIDIA effect show up in the economic data? When does this productivity story start to really become something that is real? Because at the moment it feels like it's NVIDIA and then huge spending by the big server operators, and then customers are going to start using it, and then at some point we're going to see the effect of this. And it's that last bit that I think we've yet to see. When does that happen?
I mean, I'm not an economist, so it's going to be hard for me to like really nail down a time there. But I think the thing is, if you look at the timeline, you can see that the cloud operators have been buying this kit with gusto, tens of billions of dollars they've been spending on it. We're only just starting to see them reap the benefits of that, i.e. spending on AI-based cloud services, also cloud-based AI services. That's only just started. So is when that starts to pick up, then we really see that it's being deployed in companies in a significant way. And that then is when you start to see it presumably have an effect in the real economy. So it's a sort of multi-part chain where maybe on the second domino, there are a few more dominoes to fall before we get there.
Bloomberg's Alex Webb walking us through the NVIDIA story. We thank you so much. And of course, NVIDIA, one of our top stories, alongside the BOJ ending its era of negative interest rates. We're going to get back to the day's big market story next. Stick with us. This is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole, ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. We're 30 minutes into your European trading day this morning, this Tuesday morning. We're flat on the stock 600. The FTSE 100 up 0.1%, but generally speaking, we're flat across these European equity markets. We've seen some movements higher in some food businesses or fast-moving consumer goods companies, the likes of Unilever, that one moving higher on the back of news around its ice cream business, but elsewhere. And there's been other capital markets activity taking place as well. Let's get to the broader macro themes, though, driving markets. Joining us now to talk about the markets in 2 minutes, Paul Dobson, Bloomberg's executive editor for Asia Markets. Paul, good morning to you. Let's start with the BOJ then. The BOJ steps away from all of that ultra-loose monetary policy, just stops. And as a result, we don't see a huge amount of movement relative to that event, that news event, if you like, in the yen. And actually the yen weakening down by 0.8%. What are you watching for next on this story?
Yeah, so interestingly, you should say, Anna, it's not exactly stepped away from everything, okay? It has abandoned the negative interest rate policy. It has also done away with the ETF purchases that it was doing previously and the cap on the 10-year yield. But it is still buying bonds. It is still doing quantitative easing, and it is still talking about having an accommodative monetary policy. They want to be very careful not to destroy the inflationary environment that they've worked so hard to create. And that's why we see a little bit of weakness in the yen. People are not expecting a big series of hikes based off of this announcement. There may be a gradual rise in yields, and that may start to support the yen, but it's not the sort of thing that's going to see it searing higher in this environment. And that's kind of the situation that we've left ourselves in after the pretty historic decision by the BOJ.
Okay, so historic decision, but not the start of a series of hikes, and so the yen weakens. We went through 150 and hover around there. Now the baton passes to the Fed, the other side of the dollar-yen pair.
Yeah, exactly, and that's going to be really interesting for determining the direction of the yen in particular, and of course for global asset markets as well. Everybody's talking about the dot plot. Is it going to see a shift to 2? Could that be dollar supportive? We have seen the dollar on a little bit of a rally recently. It's been gaining some strength. It's been hurting emerging markets in particular. If we do see that the Fed is going to sort of dull those bets even further on rate cuts later in this year, it may well support the currency, and that could again be harmful for the yen and see it continue to weaken on this trend.
Paul, thanks very much. Paul Dobson, Bloomberg's executive editor for Asia Markets. Let's get another view this morning. Frederick Neumann joins us, HSBC's chief Asia economist and co-head of global research. Fred, very good to have you with us. And it seemed that increasingly, as we were getting towards this BOJ meeting, the market was coming round to the idea that we would get this big movement today. And yes, to Paul's point, they're still buying JGBs, but they've stepped away from negative interest rate policy. And conceptually, at least, they've stepped away from that yield curve control policy. I mean, the framework that we were given previously. What are you watching for next, then? Because this does feel like maybe not the end of the story around the BOJ.
It's not, but we haven't gotten much clues today as to what the BOJ is thinking going forward. The market is kind of left hanging a little bit in terms of what's the framework. When would the Fed, the BOJ ease again? Is it data dependent? Are there certain thresholds they're looking at? So we have had this one-off adjustment, but we're really left hanging in terms of what to expect next. Now, our view is that actually, given that the weak yen is so important, the reflation story, there's a limit to which the BOJ can actually tighten policy. We may be stuck at zero for a while, and as we just heard, actually it's not just that we're stuck at zero, we're still buying bonds. We actually still, in effect, easing policy. So it's a very, very dovish hike as they come.
Okay, so do you think that the policymakers of a fiscal and monetary nature then, Frederick, do you think they actually appreciate, like, the weakness of the yen still? Because that's certainly what they've got this morning.
Certainly, it's not unwelcome, I think, because ultimately what helped the reflation in Japan was two things: the weak currency and changes in the labor market. Now, if you unwind the weak currency, you're actually taking a lot of reflation off the table. It's good for exporters. It helped to adjust inflation expectations, and it protects the Japanese economy against overseas competition, particularly from Chinese manufacturers, are becoming stronger and stronger in some of the sectors where Japan is traditionally good at, for example, vehicle exports. And so a weak yen is really part and parcel of the reflation story. And you want to be very careful, particularly when the Fed is likely to cut interest rates this year, not to hike too quickly or be too hawkish, because that would send the yen flying. And I think they've just managed to calibrate their message today just enough that the currency is holding around 150, which is a job well done if that was really the goal today.
Frederick, is currency intervention on the table? What is the appetite for that from the BOJ, and what is the appetite for that from around the world at the Treasury, here in Europe, that are getting the other side of those ripple effects? Currency intervention, your thoughts?
Well, we've talked repeatedly in recent months about currency intervention whereby the BOJ would step in to prevent excessive weakness of the currency, but in the event, they never intervened. They let the currency essentially adjust on its own, which does suggest that actually the bar for intervention to prevent further weakness is actually higher than many market participants expect, because the weak yen is such an important part of the reflation story. But you're right, if the yen weakens too much at some point, then that will, of course, cause consternation among other central banks, other countries, because they see that essentially as increasing the competitiveness of Japan. But I don't think we're quite there yet at this moment. And so for all intents and purposes, the yen is drifting around 150, and it's not causing tremendous alarm in Tokyo, I don't think. If it's more about the pace than the level of the currency. So if it was to drift quickly towards 160, yes, there might be intervention. But ultimately, a weaker currency is not that negative for Japan.
What about the kind of cross-asset impact then? How much does oil prices, for example, or Brent that is staying above $80 a barrel factor into the higher inflationary Japanese import story? What are the folks at the BOJ watching in terms of the commodity picture?
Well, of course, higher oil prices add to inflation, but it's not the right type of inflation, we have to be honest, because Japan imports most of that oil. And that, of course, if you have higher import prices, yes, it's good for inflation, but it also saps the purchasing power of your domestic consumers and companies. So it's a two-edged sword, really. Good for headline inflation, but bad for economic growth. What we have seen in the past, though, is the government steps in and uses fiscal policy to offset the impact of higher oil prices. And we might speculate that even this year, if we see another surge in energy prices, we might see that fiscal response coming back. And therefore, the BOJ can then afford to ignore, to some extent, rising energy prices, knowing that the fiscal side will be there and helping to cap increases in prices. And so there's an interesting interplay between fiscal and monetary policy here, where perhaps it's playing less of a role at the moment, the BOJ is thinking, than it might be in other countries.
Frederick, if I'm a Japanese investor, am I investing more in Japan after today, or am I continuing to invest the bulk of my assets overseas?
Well, the equity market took it well, so we might be tempted to go back into equities, because the message here is we're not going to slam the brakes, and that equity market, of course, like that. That's very tempting for Japanese investors. Having said that, we know that Japanese investors are increasingly investing overseas because they might not be convinced that the currency will actually appreciate that much. We know from the retail side, for example, a lot of retail investors are choosing overseas funds rather than domestic funds. So there is an onshore expectation, arguably, that the currency might continue to weaken. And that means, yes, there's a short-term equity rally, which is great. But if I'm investing for the medium term, then currency investment choices are predominant. And so, yes, Japan will remain a supplier of capital to the rest of the world, will continue to buy overseas bonds and overseas equities for quite some time to come.
What would change that? How significant would the policy response need to be to get investors to reverse that? The sense seems to be that we're one and done here this morning. If we see wage gains trickling down through the supply chain, does that change it? I'm wondering what the BOJ and the authorities more broadly in Japan need to do maybe to reverse that outflow and turn it into an inflow.
Well, ultimately, it's about the returns on investment. And so if we can actually increase the underlying growth rate of the Japanese economy by raising productivity, if we can raise interest rates without harming growth, that would raise the return on capital. And that would mean a lot of Japanese investors would then bring money back. But you can see by my response, it's a very high bar. It's more than just inflation. It's more than just raising interest rates from negative to zero. This is about fundamentally delivering higher returns on capital through productivity gains, through higher interest rates that don't harm the economy, because the economy is more productive. And that will take years and years to engineer. And that's why we've never really seen Japanese investors repatriate money in recent couple of years in big numbers. Foreigners certainly have bought the Japanese equity story. Equities are a positive story in Japan because they benefit from a cheaper currency, but broader capital repatriation has been relatively slow.
Frederick, thank you very much for joining us. Frederick Newman, the HSBC Chief Asia Economist. We thank you for joining us today with your thoughts on the BOJ and beyond. Coming up on this program, the trading and investing app Robinhood is now available to UK customers. We speak to the executive who spearheaded the launch about what you can and can't do right now. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government?
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
And the UK is no different. I think what we have today is certainly not the end. I think that's on us to keep building another product, keep adding to it, and build those diversified revenue streams that ultimately deliver a long-term profitable business.
Jordan, good morning. So one thing, you mentioned there about how you think you're going to be cheaper than some of the UK brokers, but with the UK brokers, I can trade UK stocks, or lots of people can trade UK stocks, and on yours, you can't. Is that going to limit the appeal? I mean, I imagine lots of people want to get involved in NVIDIA and all of the other, and then Magnificent Seven more broadly, and tech themes, which you can play through the US, but there might also be some appetite for something a little more homegrown.
Yeah, for us, it was about identifying UK customer needs that weren't being met on other platforms, and charges and FX fees in particulars on getting access to US stocks was something that was top of mind for these customers. So that's where we've started, and we feel like we really delivered a local product in a Robinhood way. But it's certainly not where we end, and local stocks is something we've heard from customers that they're looking for.
I'm wondering how the name Robinhood translates into the sort of popular psyche over here, Jordan. And I know a lot of people have been watching the film Dumb Money, the documentary on Netflix, Eat the Rich, and I featured briefly, apparently. You blink and you miss it in both of those. But I know that Robinhood has pushed back against some of the storytelling that was in those programs about what led you to turn off trading for retail investors during that period, and perhaps you've joined the business more recently. But what do you say to UK-based investors who might be interested in your product but not sure that your platform will always have their back, will always have the back of retail traders?
I mean, for us, we take investing seriously, and it's the customer's life savings, and for us, that's emotional for the customer and something we want to make sure that they feel comfortable and trusted as they join our platform. So for us, it's building that trust over time, and we've done that as we've built a kind of scaled and mature platform in the US. We've developed long-term products like retirement, and we've seen customers really trust us with their long-term savings. I think what we set out to achieve as a business was create access, and democratize finance for all was always the mission from the start. And removing some of those barriers that retail investors could feel like they could access the markets, I think we've demonstrated over time.
But would that never happen again? I mean, there being so much volume going through something that you have to turn off trading.
For us as a business, we've learned from an event like that and developed kind of structures and processes to make our platform and technology even more scalable. So for us, I mean, we're set up as a business for the future.
You're talking about those hurdles for the retail investor. I love what you said earlier in response to Guy. The investors here look like brokers in the States 10 years ago, but so much of that has to do with interest rates and fees, et cetera. But up until recently, Robinhood was charging 12% interest on loans when it came to margin investing. I understand that it's halted now due to some of that regulatory pressure. What concessions are you willing to make with the FCA in terms of bringing that back on the table?
Yeah, for us, it's paused at the moment here in the UK, and we continue to discuss with the regulator. I think having that collaborative engagement with the regulator is a good way to build a product.
But what might that look like? You're looking to have margin investing, I assume, back on the app at some point. The FCA isn't looking to have it in the same iteration that it is right now. What might it look like in a new iteration?
I think for us, it's working together with them, and there's the Consumer Duty framework here in the UK, which gives a great framework on how to build products, and for us, that's how we build our business anyway. But I think the important thing is when you are regulated in different markets, just to work together with the local regulator to make sure your product is hitting the right notes.
Do regulators over here want the same sort of frenzy that we see over in the United States? Like, stock trading has become very much part of the culture. People do it on margin, but there's the YOLO trade, as we were mentioning earlier, fear of missing out. There's all kinds of meme stock events that seem to allow a lot more people to get sucked into this culture. Is that something that regulators want over here in the same way as we're seeing over in the United States? Everybody's desperate over here to revitalize, rejuvenate UK markets, European markets. Is that the way to do it? Is that the way regulators want to do it?
I mean, I can't speak on behalf of the regulators.
But you have conversations with...
But what I can say is over the last 6 to 12 months, and you guys contribute to it, that there's headlines about retail investing participation in the UK. British media is positive or negative, not always just the good news stories. But I think people are talking about it. The Chancellor's talking about it. It's in the news weekly. So I think there is a nice push and momentum swell around creating more ways to access the markets and increase participation.
But is that investing or trading?
I think investing is the long-term accumulation of wealth through the stock market. And I think promoting good habits, learning, education. I mean, we've seen in our waitlist up until launching the product that over 50% of our customers interacted with a research and investment tool. And that tells us that customers actually want to learn more. They want to grow in confidence.
Yeah.
But they also need those barriers of time zones and fees removed so they actually can get started.
But in terms of education, in terms of that research, there is a broader concern in the market right now about, and Anna knows this well, about high volume and options trading bleeding into the regular market. A good chunk of that driven by retail traders who are trading very risky products when it comes to that through apps like Robinhood. Do you have a responsibility to educate them in terms of, yes, these products look cheap on the surface, but have bigger repercussions? Where is Robinhood's role in that?
The way we build our product for all features and services is to make sure customers have that information and can understand the product. And I think we see it actually twofold. It's those using our app, and that are our customers, but also those that want to access our learning materials on our website, read our newsletter. For us, that kind of runs parallel to our business, is making sure all people have access to education materials. I think that's really important as a kind of success metric as well.
But could that make Robinhood accountable for some sort of bigger loss of savings? We've heard those accusations of Robinhood from retail investors previously in the United States. Could you see that happen in the UK, especially at a time when there isn't much disposable income right now in this country?
It's building products for customers in local markets. I mean, we talked about some of the regulatory frameworks that help you build great products, but it's making sure you deliver it in a way that does give customers that information and understanding. So these are products that are out there and perhaps on other platforms, and doing it in a way that customers can understand and learn. I think that's a great opportunity for Robinhood.
Jordan, great to see you this morning. Great to see you this morning.
Thanks for having me.
Glad to see us. We really appreciate it. Jordan Sinclair, President of Robinhood UK, going live today. I get to do the gainers, Anna gets to do the losers, which is a little unfortunate.
Read into that what you will.
Unilever, Airbus, Dassault, Aviation, Rio Tinto, all on the upside this morning. Rio, I think, probably the biggest story that we're focusing on this morning, making some big kind of structural shift in terms of its portfolio, and also going to be looking like it's going to be cutting costs significantly. That stock responding very strongly to that.
Let me just take you through some of the losers then. We've got Atos, this is the big one, down by 18.8% this morning. Airbus ending talks with for a unit of that struggling French IT firm, of course. Reckitt Benckiser is still in focus, down another 4.3%. There's all kinds of negative news lines around baby formula going on with that particular business, the business pushing back against those. Moncler is weaker as well in the luxury space, 3%. And we already heard from Joe Easton the news around watches, and that's weighing on Swatch Group.
Somebody just posted a great joke about it's the scoop of the day. That's the Unilever story.
Excellent.
I can't even start with that.
You're our ice cream correspondent.
I am our ice cream correspondent. I had to do something to catch up with all the Taylor Swift correspondent that's happening on that side of the set. We still haven't discussed what our favorite are, right? For me, it's Haagen-Dazs coffee, actually, even though I know that has nothing to do with you.
Do not like to be boxed into one. I think it's important to keep your options open.
Life is a box of chocolates, isn't it? Or something
and ice cream tubs.
And ice cream tubs.
Yeah.
And
there we go. We're not playing this game.
Gelato shots. I was trying to have fun, and they're being too serious. So fine, I'll be serious too. Let's talk about what else we're watching out for today. Besides ice cream flavors, at 10 a.m. UK time, we get Germany's ZEW survey data. That is going to be hitting the terminal. Also at 10 a.m. London time, the UK selling about 4.75% of 2043 bonds. At 12:30 a.m. time, U.S. housing starts data also released. And at 2 p.m. London time, the Fed begins their 2 days of meetings on that rate decision, all waiting to see what happens on that other side of that trade for dollar yen. At 5 p.m. UK time, yes, the day continues. The Treasury will sell about $13 billion worth of 20-year bonds. And then finally, of course, we're going to be watching what that BOJ decision looks like, what the ripple effects actually look like. We were expecting a bigger reaction, and simply the fact they're saying this might be a one-and-done kind of scenario maybe limits that reaction.
I think the reaction's quite big. This big move against the yen, I think, is quite significant. In some ways, it's very counterintuitive.
Yeah, it's kind of not in the direction that 6 months ago you might have expected if you'd had to guess.
Precisely, and everybody's talking about, I know there's not going to be a big repatriation trade, there's no real reason why investors will park more money into Japanese equities, domestic investors. In some ways, this feels like a complete non-event.
Yeah.
But it's massive.
Well, yeah, I mean, but Fred Neuber's point earlier on, and Paul Dobson's both, saying this is still a central bank that is still buying bonds.
Sure.
And Ueda going on to say that he wants to get to a place where the market is in charge of where yields go. But there's a long gap between those two. There's a lot we don't understand about how we get to
We're
that
very
place.
data dependent.
And yeah, we are. And you made the point, and Ueda made the point as well, that we're still waiting for the ripple effects on these wage negotiations. It was clear that the wage negotiations at the start with the biggest companies was the pivot point. Now we have to wait for it to kind of ripple through the smaller businesses as well. You mentioned it's kind of low on the reaction radar. You're still looking at dollar yen at 150.345. That's still within the range it's been for a very long time.
So we wait for the Fed. That's kind of that's it now. Main event, and it feels even more important after the BOJ. Weirdly.
Yeah, absolutely. And whether we see, exactly, whether the Fed then steps into the driving seat when it comes to dollar yen. We went through 150 on the BOJ's move this morning. That is it for markets today. European stocks going not very far. We'll leave you with the pulse. They'll take you through the ZEW numbers and the US session. This is.
Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Wow.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The Bank of Japan ends the most aggressive monetary stimulus program in modern history by hiking rates for the first time in 17 years. NVIDIA unveils new chips aimed at extending the company's dominance of AI computing, a position that's already made it the world's third most valuable business. And on the first-year anniversary of UBS's historic takeover of Credit Suisse, we also look at how the company has pushed its market cap past $100 billion to the highest level in almost 16 years. Now, later this hour, we're also our exclusive conversation with the chief executive of Honeywell, Vimal Kapoor, on how the company is preparing for the future of automation, aviation, and energy. But first thing is first, it is a momentous day when it comes to central banks, and of course, the move that we saw in JGBs and yen. And now, for the moment, U.S. futures, a lot of the focus is now on the Fed. U.S. futures pretty much unchanged. A lot of what was priced in, for example, from NVIDIA, that's playing out in the markets, not so much. NVIDIA pretty much flat pre-market. And then, of course, the big one is the Bank of Japan. So after 17 years, and I'm actually quite surprised that the market's very cool about this because the BOJ did a great job in telegraphing it so that everyone was nice and prepared for it. But this is the first hike in 17 years by the BOJ. It's been widely expected. The governor, of course, had telegraphed this. And he also struck a neutral note at the news conference saying there's still a chance that its inflation goal will not be hit. The central bank, once again, scrapping its yield curve control program, but it's also pledged to keep buying some of the long-term government bonds, and they are in the market. So overall, you can see the yen, and we'll also get to JGBs a little bit later, but yen 150.35. The U.S. 10-year, again, waiting for the Fed at 4.3183. Now, for more on all of this, the markets, BOJ, and of course what we're expecting from the Fed, we're joined by Madison Fowler, Global Investment Strategy at JP Morgan Private Bank, and also Bloomberg's Paul Jackson. So, Paul, Madison, thank you both for joining us. Madison, this is exciting. 17 years, they got rid of it, and it hasn't been the end of the world. I mean, does it just goes to show that if the central bank telegraphs it clearly to the markets, you can almost pretty much get yourself out of any situation.
Yes, I think this has been a really incredible meeting to watch unfold. And I think from my perspective, it's one that feels very emblematic because it does feel like we are now in a new era, and maybe this time is different for Japan, and also when it comes to investing in the economy's markets as well. But I do think, to your point, the meeting in and of just by itself isn't quite a game changer in the sense that, one, it was very well telegraphed, which I think is flowing through into some of the market moves that we're seeing. And also, even though we've seen that rate hike, we are seeing a lot of accommodative leanings within some of the other details.
So let's also go to Paul Jackson, who's in Tokyo for us. Paul, when you hear what the BOJ had to say, so first of all, of course, it scrapped its yield curve control, but it's pledged to keep buying this long-term government debt. I mean, for how much longer and how much?
Hey, look, I don't think the Bank of Japan's ever going to stop buying government bonds, to be honest. I think they've got, there's too much at stake in terms of the Japanese government and its huge debt. They've got to always keep an eye on those bond yields. But look, we've heard Governor Ueda repeat this throughout his press conference. This is the end of easing of another dimension, the unprecedented easing campaign that Governor Kuroda, the previous governor, brought in 2013. So we are at a shift here. We are at a movement, a turning point. Has the move today been huge in itself? Well, no, it's not been that big. But there's a lot of talk there that, hey, this is one and done, and he's not going to be raising interest rates again this year. I would say, hey, be cautious on that one. We've heard Governor Ueda give a lot of dovish comments in the past, but look at what he actually does. He's achieved a lot more in this 11 months than anyone expected, and I would certainly caution against the view that he's done for this year.
Yeah, Madison, what's your take? Again, we had very few clues on further hikes, so is the market mispricing it?
I think it's a fair question, and I think I would be reticent to say that it's just one and done when it comes to the rate hike that we just saw. I think it's possible we could see further moves later this year, but I do think that the BOJ will remain very cautious in terms of its approach, which of course they've well telegraphed. But ultimately, I think that really comes down to the idea that saying that 2% inflation will be achieved is different than saying it already has been achieved. And I think that while the wage data that we've seen has been really promising, we haven't yet seen that really flow through into higher consumer spending. So we really need to watch that domestic demand and that business investment and CapEx data, I think, to really give us a clear sense for how successful Japan has really been in reinflating its economy.
Yeah, and this is really the crucial bit, Paul. How difficult, after the wage, we've had the wage negotiations, we're now out of negative rates. How difficult will it be to reach 2% and stay there?
Hey, well, if you're asking me, I can tell you that I think this point of the positive, virtuous cycle of prices and wages feeding into consumption, that these comments are right. This is not yet proven. We're not yet sure that this cycle is strong. It's not feeding into consumption yet. We've seen that in the GDP figures, 3/4 of consumption in real terms actually falling. There's a lot of proof that still needs to be produced that we are at this virtuous cycle. However, I think that Governor Ueda has a much more conventional policy mindset than his predecessor Kuroda, and that's the point people need to have at the back of their minds when they're thinking about how much space he wants to create with his policy tool.
But, Paul, is a bigger upward price risk something that's a possibility this year, or is that a story for 2025?
Hey, well, look, I mean, this is a tricky part. We've got a lot of complications in these figures. There's all these government subsidies for energy. And, hey, if the government pulls away these subsidies, then you're going to have, price impacts there. Already we're expecting quite a bump in inflation in February on a subsidy distortion that's going to take it probably to about 2.8%. Hey, with those kind of numbers in April, there is a risk that that upward trend in inflation is going to look stronger than it does right now. And hey, Ueda was asked this specific question in the press conference, you know, if your forecasts or the risks looked stronger in April, would you have to raise rates? And he said, hey, look, if the risks on prices are outperforming what we expect, we'd have to raise rates.
Madison, what does this mean for the Fed? Again, the dynamic between, of course, Japanese and U.S. rates is set to continue.
I think that's right. I think, U.S. rates are still in the driver's seat from that perspective. That yield differential remains still quite wide, even with this rate hike. And I think when you take that in tandem with what we're seeing from the Fed, we're looking at the idea that rate cuts now feel less urgent than they perhaps did at the start of the year, just given this resiliency that we've seen in the economic growth data, some of the stickiness that we've seen in inflation. And so we think that, roughly 75 basis points worth of cuts are reasonable for the course of 2024. And we'll surely be watching that median dot for 2024 as we head into this meeting later in the week.
So when you look at equities versus treasuries versus currencies, where do you see the most value right now?
Within the U.S. or globally?
Globally.
Globally, I think, the balance of risk from my perspective, especially when you're in a, softer landing, more pro-growth environment, is still within equities. And I think, again, you have to think about the fact that the Fed is cutting not because you're in a more protracted downturn, but because growth is good and inflation is decelerating. And at the same time, earnings have continued to surprise to the upside. So that leaves me constructive from that perspective. But I really think that first and foremost, that first move needs to come from stepping out of cash. A lot of investors are still sitting on the sidelines with yields still quite high. You probably don't have to run out of cash, but perhaps you should still jog. And, there are also opportunities across the fixed income curve. But I think, in a pro-risk environment, I would still favor stocks.
Okay, Madison, thank you so much. Madison Fowler, the global investment strategist at JP Morgan Private Bank, and Bloomberg's Paul Jackson in Tokyo. Coming up, NVIDIA unveils the successor to its all-conquering AI processor. We'll have the details next. Plus, take a quick look at the Unilever share price. Now, the company plans to separate its ice cream business. That includes brands such as Ben & Jerry's. As the chief executive, Hein Schumacher streamlines the firm by cutting 7,500 jobs. So Unilever is actually on the way up. We'll have plenty more on Unilever shortly. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
the industry is being transformed, not just ours. Because the computer industry, the computer is the single most important instrument of society today. Fundamental transformations in computing affects every industry.
Well, NVIDIA Chief Executive Jensen Huang there speaking at the company's annual AI conference. Now, the company unveiled this new processor design called Blackwell, aimed at extending its dominance of AI computing. Still with us, Madison Fowler from JP Morgan Private Bank, and also with us, Bloomberg's Alex Webb, who covers tech for us. Alex, thank you for joining us. Madison, thank you so much for sticking around. When you look at NVIDIA, I mean, he seems to be like a kingmaker. I mean, it's like the Oprah of the AI world, but he disappointed a touch. Is that because there were concerns that he can't keep up with the growth so far, or is it just that analysts expect too much of him?
It's actually a pattern we see quite a lot with Apple. The kind of adage is, buy the rumor, sell the news. There weren't any great surprises in the course of the conference in terms of the technology that was presented. It was impressive. A lot of the notes, analyst notes reflecting that, said as much. But even with Apple, when they unveiled the Vision Pro, the stock actually lost something like $80 billion worth of value, of course, for a $2.5, $3 trillion company. That's just a blip, really. But it still often loses value when products are unveiled, simply because people know what's coming and maybe there's a little bit of profit taking.
So what was your main takeaway from yesterday, Alex?
I mean, there are two things, basically. This new chipset is obviously, setting a new standard, and it's going to be harder for would-be competitors to catch up, as they are trying to catch up with what NVIDIA was already selling last year. NVIDIA's moving on to the next thing. That does then, of course, give them a great deal of pricing power. One of the reasons that we saw such a surge in revenue last year was not just that they were selling more chips, but they were also able to charge really premium prices for those chips. And as more supply comes online, there was some concern that maybe that would reduce some of the pricing power. By continuing to innovate and introducing this new lineup, which, is considerably faster when it comes to the AI processes than the prior generation, they're able to maintain that high pricing, most probably, which will then, of course, help support the pretty punchy valuation that we've seen.
Madison, what does this mean for your portfolio building? Again, if you look at the Magnificent Seven, is that something that you want to be invested in, or do you actually look at it more holistically, like AI will transform all industries?
I think it's both. I think we continue to be constructive on tech broadly. I think there's a lot of dispersion within that, so you do need to be selective. For instance, not all Magnificent Seven names are created equal. So you can see that in some of the price performance, especially over the course of the last few weeks. And when you think about the earnings growth potential within the Magnificent Seven, both in the year ahead, but also what we already saw last year, I think it's certainly something we want to make sure we have exposure to in portfolios. But at the same time, to your point, we are seeing broad industry adoption. And so I think what we're really watching there is, how does that translate into the productivity data? How does it translate into operating leverage for firms across sectors? And I think we do anticipate that, investment in AI should contribute to real revenue growth, probably sooner than most people expect.
Is the 60-40 portfolio still alive?
I very much think so. I think I also have to say that from a multi-asset class investments perspective. But no, I think, when you think about some of the changes we've seen over the course of the last decade, you've seen, I think, bonds are very much, back. We've had a little bit of a struggle over the course of the past few years as we've had, interest rate volatility. But I think with, income rates as high as they are now, you can now arguably achieve the same return that you would have perhaps, 5-10 years ago with less risk today. And so I think from that perspective, you are looking at, I think, the benefits of having a 60-40 portfolio. But with that said, I do think, it would be prudent to bolster that with alternatives. So when you are in a, stickier inflation environment, you could look at infrastructure and real assets to provide some of that protection. And of course, private markets offer, I think, the opportunity to capitalize on some of those more niche opportunities that perhaps you can't always unlock within public markets.
Madison, on Thursday, we also have the Bank of England.
Yes.
And there's not much expected in terms of policy change. But do you start worrying about, I guess, the weakening of the labor market?
I think it's a fair point. I think out of all the developed world, central banks, I think when you think about the BOE, the Fed, and the ECB, we think that the BOE is probably the last to cut. That's probably going to happen towards the back half, towards the end of this year, in our view. Of course, the risk of holding on, to higher rates for too long. Creates the potential for weakening the labor market. But at the same time, you are still looking at, inflation that's still quite high, even though it is past its peak. And so I think we're just really hitting at that tension and that balance that all central banks are really grappling with at the moment.
Wonderful. Thank you both for joining us. Madison Fowler there from JP Morgan, Private Bank, and Bloomberg's Alex Webb. Now, coming up, we'll be discussing the rivalry between the U.S. and China with Robin Niblett, the former director of Chatham House, but also newly minted author of the new book, The New Cold War. That's next, and this is Bloomberg. You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Well, tensions between China and the United States shows no signs of letting up as the two sides spar over areas like defense and technology and their response to two wars on the global stage. Well, Robin Niblett is the former director of the Chatham House and author of The New Cold War. His book looks at the contest between two global superpowers and how Europe is stuck in the middle. Well, Robin Niblett joins us now. Robin, first of all, it's a good-looking book. I mean, was that the hardest part, actually, trying to get a cover for this book?
Working so hard. Atlantic Books
just delivered me the cover, said, "What do you think?" And I said, "That looks great. Let's go with it." You know, so
that's disappointing. I thought you were going to choose. I mean, this kind of really goes back to Cold War era, right?
Absolutely.
1980s, and you're trying to draw parallels, whilst at the same time saying, "Everyone, look, China's not the USSR, and the US is not like it used to be."
Yeah, I mean, I think the core element when you think about here, we think this is a geopolitical competition alone. Rising power takes on the established power, the famous Graham Allison, the Thucydides trap. But one of the things I point out in the book is that there's a really important underlying theme, which is the ideological contest between the two sides. China in particular, I think, believes that checks and balances, what we are used to in democratic societies, are bad for government, that ultimately you can't make as good a choice. The United States, along with its allies, obviously supports checks and balances, democratic government. Might be messy, but at least you get long-term sustainable answers. And each side have realized that the other is a threat to its system. So I think China probably realized this earlier. They started backing away. I talk about reversing into a Cold War, one of the big differences from the last one. They started backing away from the US technologically, in particular, a long time ago, even from trade. So I think, you know, the US are catching up with the realization.
So, I mean, there's two things that stood out for me. Is first of all, so you understand China quite intimately because of all your years at Chatham House. And I've always been told, look, you speak to the Chinese differently than other superpowers. Are we on the brink? I mean, we have a US election. If you know, the West pushes back against China so long, what will they do?
Well, I think the simple matter is any contest, and we're seeing this, by the way, in Russia, Ukraine as well, each side needs to know where the other stands. One of the dangers in the last Cold War was misinterpretation, not understanding the purpose of the other side. So, for example, around Taiwan, this is a classic area where China's trying to put down red lines, but so has been the Biden administration. Clarity becomes absolutely essential. Open lines of communication become essential. The problem is we're in the early stages of this Cold War. It's like a pre-Cuban Missile Crisis version of that. The two sides don't know where their red lines really stand. I think the South China Sea right now, in some ways, worries me more than the Taiwan crisis.
I mean, I know that President Xi, and you explained this beautifully again in the book, has certain targets for 2049 to be the world superpower. Will he achieve that, given what we've lived through in the last 2 years?
Well, I think what he talks about is achieving national rejuvenation, you know, being a moderately prosperous country. It's that lovely Chinese way of describing very ambitious goals. By 2049, however, the Communist Party needs to be legitimized in its continuing rulership of China, and that means Taiwan being inside the fold by that time. A lot of people are talking about 2027 as maybe a near term, but I think what China's trying to do in particular is make sure it's stabilized itself and that it is not dependent upon enemies. So you've seen China pulling back its technological linkages with the United States, and vice versa, obviously. I think China under Xi Jinping is willing to suffer economically for a period in order to be more secure in the long term economically.
Robin, thank you so much. Robin Niblett stays with us. We'll talk more about his new book, and of course we'll talk about where the new geopolitical reality leaves the UK and the EU. That's coming up shortly, and this is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale
and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Well, the Bank of Japan ends the most aggressive monetary stimulus program in modern history by hiking rates for the first time in 17 years. NVIDIA unveils new chips aimed at extending the company's dominance of AI computing, a position that's already made it the world's third most valuable business. And on the first-year anniversary of UBS's historic takeover of Credit Suisse, we look at how the company has pushed its market cap past $100 billion to the highest level in almost 16 years. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Well, Robin Niblett is still with us for more on his book, The New Cold War, How the Contest Between the U.S. and China Will Shape Our Century. Let's discuss what the new reality also means for Western powers and the future of the UK. Robin, first of all, congratulations on a short, well-thought book that tries to explain the very complicated world we live in. Where does the EU sit on this? So between this big rivalry, the U.S. and China, the EU, I guess, is struggling to really find its own voice.
Look, I think the EU would be struggling more if it weren't for Russia's full-scale invasion of Ukraine. In a way, the possibilities to divide Europe away from the US in the contest with China would have been more possible if Putin hadn't invaded Ukraine. China is then forced to make a call one way or the other. It might be an axis of convenience, but ultimately for China, Russia losing is the worst outcome. They don't need Russia to win, but if Russia lost, China would be left alone against a United States and a resurgent NATO and a resurgent West. So by linking those two sides together, the Europeans have realized we now rely even more on America for our long-term security. We're facing a belligerent Russia. So even though they're skeptical about some of the U.S. steps to try to sort of extract China from their economy, we're much more dependent on China than the Americans are. We've run trade surpluses over time, certainly Germany has with China. It's a different type of contest. I think for them, for Europeans right now, it is a matter of trying to work out, will Biden win or will Trump win? Because if Trump wins, then suddenly that reliance on the United States becomes much more risky.
But Robert, so you have a whole chapter on this renewed transatlantic partnership. Yep. Can the U.S. actually sustain it? I mean, we always talk about U.S. exceptionalism. Yep. They're fighting two wars. They're very divided internally. I know they have great innovation, but where is the U.S. right now? Can they afford all of this?
The U.S. can afford all of this in terms of money. They can certainly afford $40, $50 billion, $60 billion over 3 years to support Ukraine. If you look in the total map of spending and expense, especially as the bulk of that money is spent inside the United States. The question is, can they afford it psychologically? Just as America was trying to think that we need to focus more on ourselves, that was the source of the first Trump victory, Biden wanted to say, no, I've got a better plan for rebuilding America. Instead, American voters are seeing the United States pulled into 3 conflicts in different ways simultaneously. So my worry isn't about the money, it's about the political support. And I think this is what Europeans realize as well. So what they're trying to do is saying, look, we will put more skin in the game. We will spend more on defense. We'll buy more of your liquefied natural gas. We'll do the things that Trump 1 asked us to do, so you'll stick with us.
But is this really the end of multilateralism? And where does it live? For example, the UK, we have an election this year. It's a small, open economy.
I think it's multilateralism, if we're talking about a UN system, is on hold for the next 20, 30 years. China, in a way, sees multilateralism as a useful prop, but they're investing their effort in the BRICS, in spaces where they can have a dominant voice. And they think they're in competition with the G7. And that's the way they're seeing the world. And the UN, in a way, is a bit of a side picture on this at the moment. For a country like the UK, look, it was almost be more difficult for the UK if the world was stable, because that would expose the UK's vulnerabilities. But as a permanent member of the UN Security Council, a member of the G20, a member of the G7, actually has a bit of a voice in this conflict. In a more dangerous world, in a way, some of the UK's strengths stand out a bit more strongly. Forces the EU to maybe concede some things to it might not otherwise. So I think the UK can navigate this.
But, I mean, again, the world is very complex, and it feels like there's more bad news than encouraging news. So how does a country thrive in this kind of environment?
The first thing you've got to do is make sure, if you're in a democracy, a country. My book, in the end, is targeted in the last section on what liberal democracies need to do.
Should do.
Yeah. One of the key elements of this is to make sure that we are strong in ourselves. And that means being strong economically, strong politically, and in the end, trying to knit together this sort of G7, which is now including as well Australia and South Korea, into a grouping that can survive the turbulence of the next few years. Obviously, right now, in 2024, Donald Trump might look at the G7 and say, hold on a minute, who do I have the biggest trade deficit with? The US has a trade deficit with the G7 of $340 billion that is bigger than the deficit it has with China at $280 billion, roughly. So you could see him saying, I don't care about this G7. What's all this thing about? So I think at the moment, what we need to do as Europeans is focus on ourselves, build a little bit more internally, invest more in our economies, invest more in our defense, and see where we take it from there.
I mean, every time I ask this question to a head of state, they always roll their eyes. But is there any way of Trump-proofing some of our economies in case he gets to the White House in November?
The Trump-proofing is partly about defense, but also economically. I think it is possible to Trump-proof the economy. It means being able to make sure that you've got alternatives in your global markets. I think the biggest challenge for Europe going forward is going to be thinking about how it integrates Africa. And one of the main things I talk about in this book is that although it's a new Cold War, it's not like the last one, because most of the rest of the world doesn't care about it at all. They are triangulating between the two big sides. And there's a huge opportunity for Europe right now to look, and America, by the way, to look at the global South countries, to look at Latin America, to look at Africa. You notice the Brazilians are suddenly being flooded with cheap Chinese exports. They're not happy with that very transactional approach. So I think we need to try and win the new Cold War in the global South.
Robin, whilst reading this book, is there something that surprised you? I mean, I know you look at this, day in, day out, and have been in foreign affairs for the last 15, 16 years. But through your research, what's the thing you're most optimistic about?
You said there's something that surprised me, and then it's the thing I'm most optimistic about. The thing that surprised...
They're not the same?
Unfortunately not. The thing that, I don't know about surprising me, but really came to my realization is this sense that we're in early stages of the new Cold War and we do not have rules for nuclear weapons. The Chinese are investing in their nuclear weapons. They'll be up around 1,000, probably, certainly 800 nuclear warheads soon. They want to get probably to match the US and China at 1,500. At that moment, if you're in the US, you're thinking, hold on, it's not China with 1,500 and the US with 1,500, it's 3,000 together. That's something that dominates us. So I talk a lot about arms control. We need to get that going again. I think on the positive side, I've been amazed at the extent to which, for the first time, we're seeing a knitting together of America's Pacific allies and its transatlantic allies. You've got Japan, South Korea, Australia, sort of being integrated in a way, in with the NATO, bigger EU, UK, Norway. And that's a very powerful combination if you can knit it together over the coming years. This is where the Trump presidency is a risk. But I think use 2024, you've got the 50th anniversary of the G7 coming up, use this year to really invest and in a way, Trump-proof that trans-Pacific, transatlantic alliance.
Robin, thank you so much, as always, for joining us. Robin Nibbett there, the former director of Chatham House and, of course, author of a new book, The New Cold War. Now, coming up, today marks a year since UBS took over its Swiss rival Credit Suisse. We'll bring you a deep dive on just how advantageous the deal has been for the bank next. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Who would have expected UBS shares to have soared since the bank took over its ailing Swiss rival Credit Suisse 1 year ago? Yet that's exactly what's happened, with the stock hitting a 16-year high in early March. Behind this, confidence in Chief Executive Sergio Ermotti's turnaround of the Swiss lender and integration of the two banks.
I think it's very important for investors to understand how we are connecting the dots between what we said in summer last year and in respect of our long-term plans.
Ermotti's goal is simple: to make UBS the undisputed global wealth champion and take on Wall Street rivals where they have the home advantage. In the US, UBS chief hopes to leverage former Credit Suisse clients in the US and manage their wealth, including those still building their fortunes. But catching up with these American financial giants will take time and come at a cost.
More than 50% of our cost is headcount, and there are duplications, but we try to do it over time.
European banks, including Deutsche Bank and HSBC, and even UBS, have previously tried to crack the US market and had to pull back. But this time, UBS aims to be the one left standing at the end of this round.
Well, Bloomberg's Samuel Etienne there reporting on the outlook for UBS 1 year after the lender took over troubled rival Credit Suisse. Now, we're joined by Bloomberg's Charlie Well here in the studio. I mean, I remember like it was yesterday. I can't believe it's been a year already. So the 19th of March, 2023, we were in Bern for that press conference. We knew something was cobbled together. They wiped out the AT1s, but it feels like AT1 is back, and actually UBS has done very well out of this deal.
So much better than expected. I mean, when they announced that deal, it was so hastily put together. I remember immediately
after, the share price fell as much as 16%. But look, fast forward to where we are now, the share price for UBS is up 60%. They've got a market cap of $100 billion. And so this is actually going a lot better than expected. And really what UBS got here was a bigger investment bank, but they also got this potential with wealth management, and that is so attractive to them. By acquiring Credit Suisse, the funds that they're for clients that are managed by their wealth unit are up a fifth to $3.4 trillion. So that is a huge opportunity for them.
I mean, I think at the time they were worried, which is why then I think in August they kind of said, look, we don't need that much government backing, is that they were worried about what they'd find, especially in the investment bank of Credit Suisse. So I guess some of the unwinding is maybe a little bit less messy than it could have been, unless this comes further down the line.
Yeah, they just didn't have time to do a lot of that diligence that you would expect. And I think that's why there was some of this government backing. And look, Sergio Armati seems to be doing an incredible job here, right? He's done this before. He was CEO from 2011 to 2020. He was brought back to do this. He's been something of a stabilizing force during that period from 2011 to 2020. He kind of did that pivot away from investment banking at UBS into wealth management. And that seems like something that they really want to do here, right? And their focus is on the United States.
Yeah, and it has to be the ultra-rich, right, if they're going to close that gap with Morgan Stanley.
Absolutely. I mean, Armati has this stat that he loves to cite, which is that there are 36,000 people in the United States who have liquid net worth of over $100 million. And so we hear a lot about how the U.S. still is the center of kind of global money, and that really is the case here. But they face a lot of competition, right? I think Morgan Stanley is what they really got their eyes set on. And I think the goal is to try to kind of use their increased footing in investment banking that they have through Credit Suisse, through that acquisition, to try to funnel clients into their wealth management unit. But they have a lot of competition, as I said. UBS, they've got about 6,000 financial advisors in the United States. Morgan Stanley, they've got 16,000.
But so I guess the concern is that they lost clients that were banking with Credit Suisse. And so how do you get those clients back, especially in Switzerland?
Yeah, I mean, you've got to rebuild confidence, right? And that's something that, we're seeing, with concerns about the larger Swiss banking industry. And I think regulators are talking about, the need potentially for this bank to have more capital now that they've grown so much. But it's kind of rebuilding trust, but also kind of, using their increased tools that they have with this larger investment bank to try to funnel people in. I mean, in the United States, they tried to do this before in some senses with their acquisition or the attempted acquisition of Wealthfront, which is a robo-advisor. And so it's kind of a new take and trying to kind of, help create wealth through investment banking clients and then bring them into that wealth unit.
Okay, let's also bring in Tom Metcalf, who oversees all of our, of course, banking coverage across the MEA. Tom, I don't know whether there's going to be more introspection about what exactly happened with Credit Suisse and whether, something like this needs to be avoided. Like, what's the feeling in Switzerland?
Yeah, it's interesting to be here a year on. I remember sort of a year ago, it was such an intense period. And, walking through Zurich today, just any old day, right? I think there is still such a huge moment for finance, but also for Switzerland specifically, that, this is still rumbling on. Just today we had the, Swiss National Bank saying, hey, we should think about giving more regulatory sort of capital requirements to something like UBS, given its size. From my perspective as I sit here, it's one of those stories that's going to run around, not for months, but for years. And, frankly, finance, has pretty much changed forever.
So, Tom, again, 1 year on, are you surprised at how well they've done out of it? I mean, this is difficult because they're pitching for new business, they're pitching for new clients, so they're flying the airplane, whilst at the same time they have to integrate, let people go. So this is not an easy job.
No, absolutely, and that's what the executives have been saying is actually the hard part starts now, in terms of, yes, they need to really start to drill down into costs. Probably many more job cuts to come. I think it was once, I think back at the time, described as potentially the deal of the century, with lots of caveats because it's so hard to integrate massive institutions like this. But I think if you're looking at for a report card of the first year, UBS are probably going to be pretty happy. Look at that share price, right? It's now north of $100 billion. On the day after the deal, it was something around 60 billion. So anyone's going to take that kind of uplift. And yeah, the big question is, it's all about the execution. That's what all the analysts are saying is, if they can execute, this will indeed be deal of the century, but there's a whole lot of sort of minefields and sort of trips up ahead.
So, Tom, I mean, again, the questions that we have, are they around execution? If you're also a Swiss citizen, you used to be able to choose a mortgage between two banks. You're only now left with one bank that's probably too big to fail.
Yeah, I mean, that is the interesting thing, right? As part of the deal, kind of all those competition concerns were waved through. And, you know, for me, that's the most interesting thing, because those concerns are still absolutely floating around out here. And it's sort of like, is there really any recourse at this point? Because, you know, quite rightly, UBS might point, hold on a minute, we had sort of this was all passed through, this was all legal. And they are very, very keen, in the case of Swiss banking, to keep the Swiss unit. And you know, I think the sense is they will do, you know, their absolute utmost to keep it within the group. You know, that is, you know, probably more of a political thing than perhaps a corporate concern right now.
Tom, overall, I know we were talking at the time last year, and I remember actually being on text messages with you, you know, that Sunday. It's kind of tattooed to our brain because it felt like it was such a big deal, and it was cobbled together. And frankly, just 4 days before, no one was really expecting this huge takeover. Tom, at the time we were talking about whether it would kind of push more consolidation, more M&A in the industry. Do you think that's a real possibility with the Capital Markets Union, or is this just, you know, specific to UBS and Credit Suisse?
So if we're talking about these big cross-border deals, everything all the top bank executives say is around that, you know, sort of Capital Markets Union is for that to happen in Europe, they need the regulators to sort of smooth the way. And that's obviously them talking their own book. So, you know, my sense is those mega deals are probably not going to happen without some changes on the regulatory front. But, you know, every day we're hearing, you know, chatter about, you know, might this firm do something with this firm? There's definitely kind of those animal spirits stirring. It just might be more on, you know, domestic deals or bolt-on acquisitions. But I think, you know, in terms of, you know, what's coming down the pipe in 2024, I suspect will be the year of mini M&A maybe in banking.
I like that, mini M&A. And Charlie, but it's still, you know, very difficult. I mean, I know we talk in wealth management whether UBS can really rival Morgan Stanley, but it's very difficult with, you know, an investment bank that's just nowhere near some of the Wall Street titans for a European bank to take on Wall Street.
I mean, that's exactly right. And look, other people are trying to do this as well. There was a great interview on Bloomberg TV yesterday with the CEO of Barclays, CS Venkatakrishnan, talking about how Barclays wanted to try to, you know, kind of establish or kind of build on some of its footing that it has in the United States as well. And so this is really challenging, and it's something that a lot of people want. What's interesting yesterday that Venkat, as he's known, spoke about was kind of Barclays as this almost deglobalization play, as how for, you know, investment banking, sometimes it can be good not to have everything concentrated in the United States. He was certainly pitching London. UBS could be talking that as well in the future as we see this kind of deglobalization theme, having some of that counterparty risk in another country, that could bode well for them.
All right, Charlie and Tom, thank you so much. Charlie Wells and Tom Metcalf joining us today on banking. Much more to come. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife.
You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal.
The deal.
That deal.
The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Barclays is seeking to expand its relationships with sovereign wealth funds and private equity giants as it broadens its footprint in advisory and equity underwriting. Well, Barclays chief executive spoke exclusively to Bloomberg.
Lending is an important part of what we do. We are a very big player in the fixed income markets, in the debt capital markets, as well as fixed income trading. So lending is a part of what we do, but we're just trying to broaden it into more advisory and more equity-related revenues.
How much is this sort of a new model of banking that's basically taking all of Wall Street and a lot of the global banks too, which is trying to cater to the whole client rather than, say, go after specific deals and be focused on, for example, being at the top of a league table?
Yeah. I think it's an important part of the shift that's happening. And it's happening because previously, in the investment banking side, we were working with corporations. And since then, we still work with corporations in a very big way. But in addition to that, you've got the financial sponsors and the sovereign wealth funds. So the growth of concentrated pools of capital makes it important to have that full relationship with those players in the market.
This week, we do get a Bank of England decision. Is it beneficial if rates stay higher for longer, or do you want them to come down to support the economic growth and maybe some of the engine that John was talking about?
So ultimately, that's a decision they have to make. It's very important to balance.
Sure, but,
yeah.
you know.
You've got to make a call. I actually think a little prudence and waiting a little is not a bad thing.
You think there is an option there to wait a little longer then? Why do you think so? Why is the bigger risk maybe to cut too soon and not to hold too long?
Well, I think that the economy is stabilizing. Employment is still robust. Inflation is coming down. So I think on the balance, it might be more prudent to wait a little longer. Now, our house view and that of many others is for more rate cuts over this year.
Would the same apply to the US? The same characterization of the situation?
I think so, yeah.
Well, but just, would that be good for you? Are high rates good for banks, or are they bad for banks? This has been a perennial question.
Stable rates are good for banks.
Well, that was the Barclays chief executive officer speaking exclusively on Bloomberg. Now, to some of the other stories making news, and China's top securities regulator has accused developer Evergrande of falsely inflating revenue by more than $78 billion in the 2 years leading up to its failure. Well, Evergrande is a defaulted developer at the heart of China's real estate crisis. Chinese regulators have laid much of the blame on Hui Ka-yan, the company's founder and former chairman. No criminal charges against Hui have been made public, and his whereabouts are not known. Now, Bloomberg has learned that Donald Trump has ruled out Vivek Ramaswamy as his running mate for president. Sources say the Republican nominee is now eyeing the entrepreneur for a cabinet job. Trump personally told Ramaswamy he will not be his vice presidential pick, but is considering him for posts, including Homeland Securities. Of course, the picture across the board for markets, a lot of focus on everything that has to do with the Bank of Japan. We look at yen, treasuries. We now move on to the Fed next, and then BOE on Thursday. Surveillance next.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
From the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I want it to succeed myself. Patented in the UK in 2021 September with copyright protection. I have a logo for the Gel Razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
First interest rate hike in 17 years.
So two things. Number one, this is well telegraphed, right? So on one hand, people were expecting this, but some of the rhetoric out of the central bank wasn't exactly hawkish. They basically were indicating that they weren't prepared to hike again. So that's probably why this currency pair is basically, I don't know, dead in the water. I mean, I don't understand this at a certain point. This is what everybody was waiting for, and I guess buy the rumor, sell the news.
Well, I think you nailed it earlier on in the week. There is a big difference between the end of negative interest rates and the end of easy money. This is not the end of easy money in Japan. I think Governor Ueda coming out of his way to say they need to keep things accommodative. So yes, the end of negative rates in Japan, but the end of easy money, not quite yet. We've got to work out what this cycle is going to look like. I remember you and I were talking about this. The first time the Bank of England hiked interest rates, when was that? The end of 2021? And I got on the phone and I said to you, what matters here is not the first move, it's how far they ultimately go. How far do you think the BOJ is actually going to go after this move overnight?
I think to where they are right now. I mean, maybe eventually they'll go higher, but right now, from all of the commentary that I've been hearing, there's no indication there is going to be any further rate hikes, just simply because they don't have to. I am curious, when you take a step back, this is the end of the negative rate experiment, right? Because this was the last central bank to remove that negative rate policy. When we write the book, will it be considered stimulative or actually somewhat suppressive of growth? I actually wonder what the history books will say.
I think a lot of books are going to be written on that, and they'll be inconclusive for a long, long time. I think whatever you thought during the negative era is what you're going to think in the subsequent 20, 30 years. We'll be arguing about this forever, and let's hope we never get in the situation again where we need to have a conversation about negative interest rates. Big changes in the last 12 months. The Federal Reserve has gone from 0 to 550. We've seen a similar move at the ECB as well. And here we are. Let's just start with this. The Global Fund Manager Survey from Bank of America is out this morning. We'll be talking about some of the highlights through today. Global growth expectations, 2-year high. Risk appetite, the highest since November 2021. EPS optimism, the highest in 2 years. That is with interest rates with a 5 handle in America. Does that look restrictive to you based on what we're seeing in the FMS survey coming out of B of A this morning?
Bonds and stocks are operating on 2 time frames right now. Bonds are considering whether Fed funds rates are a certain level, and they're looking at potentially the inflation rate. Stocks are looking at what's going on in the tech revolution. They're looking at productivity boom. They're talking about all these other things. At what point do stocks wake up to bonds? And we haven't crossed that threshold yet. And that's what it seems like. Are we going to test that threshold at which stocks start waking up to the prospect of higher for longer?
How about this, when we spend more time talking about Jay and less about Jensen? Maybe that's going to be the turn. Equity futures right now on the S&P 500, negative by 0.2%. We had a bounce back in yesterday's session following 3 days of losses. Equities doing okay. In the bond market, yields still very high and close to the highs of the year so far. 431.83. We've been grinding higher over the last 5 or 6 sessions. In the FX market, the euro, 108.41. That currency pair negative by about 1/3%. Just a bit of dollar strength through G10 Lisa yesterday and again today.
Which raises this question, how much emphasis is there going to be tomorrow on Jay Powell in deciding whether or not the dollar is going to keep rallying? At this point, over to you, Jay. Let's see what you got. Is that really going to be the deciding factor? The BOJ is off the table. It's all about the Fed.
Fed decision just around the corner. Coming up through the next 60 minutes or so, we'll catch up with Mark Cabana, the head of US rate strategy, as investors continue pushing back bets on the Fed's first cut. Liz Everett-Chrisberg of the Bank of America Institute on the state of the US consumer, and Marcy McGregor of Maryland Bank of America Private Bank on the equity rally ahead of tomorrow's Fed decision. We begin with our top story. The FOMC meeting getting underway today as traders push back bets on the Fed's first cut beyond June. Mark Cabana of BofA Global Research is looking for discussions on the balance sheet, writing this: the Fed needs to prioritize how and when to slow QT, given the reduction of excess liquidity in the system. Slowing QT is Fed priority number 1. Mark, I'm pleased to say, kicks off our show this morning. Mark, good morning.
Good morning.
Good
Thanks
to see
so
you.
much for being here.
Thank you for having us.
Great to have you.
Looking forward to the program for the next 3 hours or so. Let's kick it off with the balance sheet.
Sure.
What are the considerations that go into making a decision like the one that they have to confront through the next 24 hours?
Sure. So we do think that the balance sheet's going to be a really important point of discussion at this meeting. And really the Fed is going to have to answer the question, how far and how much excess liquidity do they want to remove from the system? And how comfortable are they pulling that cash out of a banking system that appears to really be wanting to hold very elevated amount of reserve levels and cash levels?
Taking a step back, we're talking about a $7.5 trillion balance sheet that has shrunk from about $9 trillion. And people are really talking about this because we don't really understand what effect it's actually had. What effect has that balance sheet shrinking by $1.5 trillion, has that had on a market that seems pretty intent on rallying?
Certainly. So the clearest thing that excess liquidity reduction has done is it's really pulled cash out of money market mutual funds, or at least it's pulled the excess cash that those funds are investing with the Fed. And that has caused money market rates to rise to some extent. Treasury bills are not nearly as rich as they were, let's say, a year or so ago. But that's really the only impact that it's had. In terms of a broader marketplace, it hasn't done much at all. And so the Fed is going to have to ask, well, how far do they want to keep pushing the balance sheet reduction, and how much do they want to risk, again, pulling some of that excess liquidity out of commercial banks that have been, in our assessment, clearly bidding up to hold that excess.
The fact that it hasn't had as clear and obvious an impact on markets is the reason why a lot of people aren't paying attention to it. To be completely honest, a lot of people's eyes glaze over and they just say, we want to know where the dots are. Do you think that there's too much emphasis on the dots?
Well, okay, so in terms of priority 1, as we wrote, that was with regards to the balance sheet discussions. The Fed's real focus is going to be what do they want to do with the overall setting of interest rate policy? How long do they want to keep rates at current levels? And how much restrictiveness are they comfortable exerting on the economy? Those are the big questions that they have to ask right now. So the market, in our view, is right to focus its attention on the dot plot, keeping the balance sheet secondary, but slowing QT, when they think about all the considerations around the balance sheet, that is indeed the #1 priority that they have there. Now, on the dots, the big question is, are they going to show 3 cuts or 2 cuts for their expected 2024 outlook? And that's going to have, we think, a pretty notable rate market response either way, because the market is quite divided on this. You talked about the fund manager survey that Michael Hartnett does. We do our own survey of really rates and FX clients. When we ask them their expectation for the dot plot, 68% say that they think that the Fed will keep 3 cuts for this year, so 75 basis points of total rate cuts this year. Now, that's that survey closed about a week ago. That has probably shifted a little bit as you look at how much the market is taking out Fed rate cuts for this year. The fact that the June meeting is now right around 50-50 in terms of whether the Fed will go or not. So the responses that we got suggest that maybe the market is closer to 60-40 in terms of investors thinking that they'll show 3 cuts versus 2 cuts. But that's going to be the big question. And the market's going to respond in either direction, we think. If they only show 2 cuts, not the B of A economics base case, but if they only show 2 cuts for this year, so they take out 1 cut, we think that the 2-year will sell off 10 basis points. We think you'll see the curve bear flatten. We think you'll see the dollar rally, and we think you'll probably see risk assets take it on the chin to some extent. And that is because the market's going to be questioning, well, how accommodative is the central bank really going to be? If they show 3 cuts, as they had in December, and as our economists expect that they will, we think that the 2-year will probably rally by 5 basis points, curve will bear steepen, and you'll sort of see dollar weaken and risk on. So it is a bit of a pivotal point, we think, for markets. And I know I've been talking for a while, so feel free to cut me off. But Lisa, you asked before, how long until the equity market catches up with the bond market? And I do wonder to some extent, how long before the bond market actually catches up with the equity market? Because you can look at price action and say, oh, well, monetary policy is just way too easy and rates are too low, and that's why the equity market is doing this. When I talk to our equity market folks who occupy this space as well, what they say is, Mark, we kind of don't care about interest rates. Have you seen the growth profile of these companies? Have you seen how strong the economy is running? Jonathan, you talked about that fund manager survey, right? All these like super strong growth, risk appetite very high. They just don't think that whether or not you have 10s at, let's say, 430 or 10s at 475, maybe even 5%, really disrupts the investment narrative. And that is a real question that the market's going to have to rebalance. And I do wonder if the bond market might have to rebalance to what the equity market's telling
We're in your home this morning, so I won't cut you off. You can have as much time as you like. I do want to ask about something you said, though. The equity market will take it on the chin. And then you really laid out as to why the equity market will probably take it on the chin. So it makes me think about bonds all over again. If you think about what's happened this year, January 4.1% on a US 2-year. We've gone from 4.1% to 470 this morning. Over the last couple of weeks, we've been in and around that level, and equities have done nothing in the face of that, which just tells me that yields can go even higher, and they can keep going higher until they become a problem. Is that the right way of thinking about this?
I think that if you were to just look at what financial markets are telling you, and if you were the Fed and only looking at financial conditions, I think financial conditions would tell you that monetary policy is not yet sufficiently restrictive. Now, the Fed believes, and Jay Powell says time and time again, monetary policy is set well into restrictive territory. Financial conditions are not telling you that. Also, I can't help but rewind to where we were last summer and fall. And as you know, at that point in time, we saw rates sell off very materially. 10-year rose over 100 basis points, 10-year real rate rising about a similar amount. And risk assets and financial conditions were relatively stable throughout that. Right? The equity market didn't really go down that much. Credit spreads didn't really widen that much. And yet the Fed told us that they were very worried about higher term premium, and they felt that higher interest rates were doing the work for them. But when we looked at risk assets, we said, risk assets don't care about this. And risk assets don't care about the rate rise because we thought it was all about better growth expectations. And the market was taking out Fed rate cuts, so that's what was pushing rates higher.
Yeah.
And risk assets were generally okay with it. And then the Fed subsequently eased in the face of that, right? And they drove rates lower really over the course of November and December through very dovish rhetoric. And the Treasury Department also did their part, right? They issued less long-dated bonds than we thought. So both the Treasury and the Fed eased financial conditions very substantially. And risk assets kept rallying over that period of time. So I go into this to just make the point that risk assets are telling you that the economy is fine, corporate growth expectations look very, very healthy, and maybe interest rates are really not all that restrictive. That, I think, is the key question that they have to grapple with over at the meeting the next couple of days. The balance sheet will certainly be a focus. It's secondary to the setting of monetary policy. And then they really do have to ask themselves, well, how restrictive are we? And I do think that that is an open question for them.
Can we wrap it up with a target? 470 right now on a 2-year. What are you guys thinking about now?
So what we're thinking about is, and what we're telling clients, and we've been saying to clients over the last probably month or so, is that they can be patient, clients can be patient on adding duration, because we do think that rates will continue to rise in the near term here. And that is really due to the fact that growth has been so strong. Again, risk assets are not telling you that financial conditions are particularly restrictive. And as a result of that, we think that investors can probably wait until, let's say, rates are around 450 to really add long positions and be comfortable with that. So, excuse me, we do think that the path of least resistance in near term is probably higher rates. We do have a Q1 10-year forecast of 4.4%, still very comfortable with that. Our end-of-year 10-year forecast is 4.25%, well above consensus. Used to be well above the forwards, not really anymore. And we do think that that's very consistent with just this expected very strong growth backdrop in the U.S. economy, and maybe a reassessment of the Fed in terms of how much they will actually be able to cut this year.
You've given us a ton to think about. It's great to kick off the program with you, Mark.
Yeah, thanks so much for having me, and thanks again for coming in.
Thank you very much, sir. Mark Urbano there of Bank of America Global Research. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Shonali Basak. Hey, Shonali.
Good morning, John. President Biden and Israeli Prime Minister Benjamin Netanyahu held their first call in more than a month, and it was to try to ease tensions over Israel's war in Gaza. Netanyahu agreed to send a group of advisors to Washington to talk about his planned invasion of Rafah, and Secretary of State Antony Blinken is heading back to the Middle East for his 6th visit since the Gaza war broke out. He's been in Europe and Asia since last week, and now he'll extend his trips with stops in Saudi Arabia and Egypt to push for a ceasefire between Israel and Hamas. And former President Donald Trump is narrowing down his list of potential running mates for November. Bloomberg has learned that Trump has ruled out Vivek Ramaswamy as his vice president. Sources tell us, though, that Trump told the entrepreneur personally he won't be his vice presidential pick, but is considering him for a cabinet position, including as a possible Homeland Security secretary. And the Bank of Japan has ended its era of negative interest rates. The central bank is signaling that easy financial conditions will continue, giving few clues on when to expect further hikes. The central bank is shifting from its negative interest rate policy after saying its 2% inflation target had come into sight, and the move has prompted a slide in the yen past the 150 mark against the dollar. And that's your Bloomberg Brief, John.
Hey, Shonali, thank you. Up next on the program, making the case for Tesla.
My view on Tesla is it's easy right now to get negative. They're going through a white knuckle period. They will gain more share. The leverage will be there. And I believe ultimately numbers, EPS growth will start to come back up.
That conversation coming up next, live from New York City this morning. Good morning.
unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Wednesday, the Fed decides.
They are scared stiff of getting this wrong.
The markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good data. We're still seeing sticky inflation.
How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Live from New York City this morning. Good morning. For our audience worldwide, live from the home of Bank of America here in New York throughout this morning for the next 2 hours at about 41 minutes or so. Your equity market looks like this on the S&P 500. Futures pulling back ahead of the Fed tomorrow. Equity futures just a little bit softer on the S&P 500. We're down about 0.16%. Yields pulling back very, very close to 2024 highs in the last couple of days. 431 on a US 10-year. In the FX market, the dollar stronger against G10 yesterday. Repeated that again today. 108.42 on euro dollar. Under surveillance this morning, making the case for Tesla.
My view on Tesla is it's easy right now to get negative. They're going through a white knuckle period. I mean, China demand's been soft, the margin story, the communication. But look, my view is on the other side of this will be a company on its way 2.5, 3 million units when we look at the next few years. They will gain more share. The leverage will be there. And I believe ultimately numbers, EPS growth will start to come back up.
Here's the latest. Tesla are looking to raise prices on the Model Y and regain investor confidence after becoming one of the worst performing S&P 500 stocks of the year. Bank of America's senior auto analyst John Murphy maintaining a neutral rating with a 12-month price target of 280, citing Tesla's, quote, unique ability to remain agile. John Murphy, I'm pleased to say, joined us now with more. John, great to see you.
Great, thanks for having me.
Let's just start with how difficult this industry is at the moment. Who's got this right? Who saw exactly where this market would be at this time?
You know, I'm doing this for 25 years, and it's always an industry that's difficult to get right. There's lots of ebbs and flows. But I think when you look at this, the one company that has been very good and very agile and sort of foundational has been Toyota. You know, and I think when you look at this 1-6-90 rule that they have, where they say basically for all the precious metals and everything you're putting in the battery in an EV, they can make 6 plug-in hybrids or 90 hybrids. With those 90 hybrids, they save 37 times the CO2 as you do with one EV. So the consumer would be a lot more adopting and is a lot more accepting, I should say, of hybrids. So that really seems like a very good interim solution until we get EVs or hydrogen fuel cells ultimately worked out.
Just to sort of underscore a point that's sort of implicit there, are you saying that electric vehicles, as we know them and as they're being produced, are not the environmentally friendly vehicle that, say, a hybrid even would be?
Well, you know, when you look at well-to-wheel, there's a lot of sort of debate on how environmentally friendly EVs are, and it's probably about a 5-year payback period versus an ICE vehicle, somewhere in the middle in an EV versus a hybrid. But the reality is that EVs work very well for folks that are in large suburban houses that can put a charger in and then have a second car. For the masses and folks that live in cities, they don't work so well right now. So it's a real challenge. So really, ultimately, what you need to do is make a better product for most folks at a better price, and they're just not there right now. And we have major issues with the charging infrastructure.
Do you think that the answer is to allow imports from China at cheaper price points, or do you think that China has its own interest for creating an electric vehicle ecosystem that is different and either environmentally sound or dominating a marketplace that's a surety when it isn't necessarily.
So one of the major complicating factors of looking at this industry is it's so macro, and it has so much to do with the broader economy. If you're Xi and you're sitting there trying to drive your economy, you're pushing the auto industry. It's your biggest employment base. It's your biggest sort of position of national pride, industrial manufacturing base. So they have a real position here to drive forward the industry and build their national champions, and they're doing it with EVs because they could never quite get around on the ICE powertrain. So really, their motivation is to drive their economy forward. It has less to do with the environment, and it has more to do with that. And what you've seen from China is 3 years ago, net import-export on vehicles was zero. It was about zero. Last year, it was about 5 million net exports. So they've become a big player on the global stage very quickly. It's really quite amazing.
Do you think this could spell the end of the global auto market? Are we just going to see a bunch of different regions with quasi-state-sponsored national champions operating in different places?
We're kind of already there in some ways.
The future's now.
Right. I mean, the Japanese support the Japanese companies. The U.S. supports the U.S. companies. I mean, we saved GM, took GM and Chrysler into bankruptcy and out of bankruptcy in the U.S. There's many people that think that Germany supports the G3. South Korea supports Hyundai, Kia. Yeah. I mean, when you look at all this, it's a major part of the economy. In the U.S., it's 4% of GDP. It's a larger portion of your employment base. When you get into the secondary market, it's twice that. So if you were trying to drive and support an economy, this is really where you start. And then you get into sort of the political aspects of support from that labor that creates this real circular reference with politicians.
So you've got to help us pick stocks, but I wonder if the government is doing that for us. Is the government doing that for us?
You know, in some ways, some of the intervention, whether it be incentives or regulation, really, are something you have to really consider here, and they drive it for you. I mean, just think about this. The whole industry is limited in the utility and value it can drive for consumers by speed limits. Right, the ultimate function here is to get you from A to B quickly, and because you have a limit, that's called the limit, right? That's a limit on the value you can actually deliver to consumers.
So there's a question between some of the subsidies on electric vehicles and the trend that's shifting toward hybrids. Which is going to win out, and who's best positioned to kind of toggle between that tension?
So usually the market wins out, and when you look at this, the consumer is pushing in the direction of hybrid. And the beauty of not a plug-in hybrid, but a regular hybrid, is you improve the fuel economy by at least 50%, and the consumer has no idea that they're driving a different kind of powertrain. It's cost-effective. It goes. They operate the way they do right now. They don't have to worry about charging or plugging it in. So I think as we look at this in the near term, we're going to see hybrids continue to gain in popularity. EVs are stagnating. I mean, in the U.S., we saw EVs drop sequentially to about 7% of the market in January and February of this year. In China and Europe, even the markets that are pushing this heavily, you're starting to see a fade in the rate of increase on penetration. So I think we're going to see a market that gets heads towards hybrids. Toyota's very well positioned. Ford's pretty well positioned. Yep. GM is playing catch up. The rest of the crew are playing catch up, but Toyota's taking the lead there.
Hey, John, this was fascinating. John Murphy there of Bank of America. It's a conversation we've had on this program before. Every time we have this conversation, I get the green activists starting to email in. Bottom line, it doesn't matter what they think. When you speak to the experts on this matter, they are not that environmentally friendly. They are just not.
Which raises this question of, okay, how much can you actually backpedal on some of the policies and some of the expectations that have been baked into the market?
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from New York City, it is Federal Reserve Decision Eve. Is that a thing?
No.
It is now. Equity futures on the S&P 500.
It's like day one of the two-day
Negative by 0.1%. They're not even awake yet.
Okay, well, you know, they will be.
Okay, we're down about 0.2% on the Nasdaq 100. Took us about 30 minutes to take a dig at Chairman Powell. In the bond market, 2-year, 10-year, 30-year. 2-year, what a repricing we've seen through this year, from 4.1% at the lows of the year, back through 4.7%, 471. Catching up with Mark Cabana here at Bank of America just moments ago, about 30 minutes or so ago, basically saying that we aren't sufficiently restrictive, and that opens the door for yields to go even higher at the long end than where we are right now.
I love what he said, which is maybe stocks aren't listening to bonds, but maybe bonds aren't listening to the stock market. And basically what the stock market is saying is that rates can be substantially higher from here and still allow this economy to keep chugging along, because there is a reason why stock markets are not paying attention to the level of rates where they are.
Yields keep pushing higher. Monday through Friday last week, and then again this week to kick off the week. Monday morning, we were pushing higher, in the afternoon as well. This morning, this Tuesday, we're down about 2 basis points at the front end on a 2-year. On a 10-year at the moment, down about a single basis point at 431. Let's switch up the board and turn to foreign exchange and check out euro dollar and a bit of dollar yen if we can as well. Dollar yen. Someone wake up dollar yen, it's amazing. 150.54. This is another day of yen weakness in the face of the first interest rate hike going all the way back to 2007. And I think we should draw the distinction between ending negative interest rates and ending easy money. This was the end of negative interest rates. I'm not so sure the Bank of Japan wants to call it the end of easy money.
Which is the reason why perhaps we're not seeing more of a reaction. Kit Jukes, he has the greatest explanation.
From yesterday?
No, today. This is the latest from Kit Jukes of Societe Generale. The FX market thumbs its nose at the BOJ and history. Essentially, that's what we're looking at right now, is the FX market saying, you think that this is something, you think this is a move? Well, check out the rest of the world. They're so far beyond you that that's nothing.
I love the title of Kit's work yesterday. What did he say? Someone tell the Japanese yen that this is a historic moment.
Exactly, which is the reason why perhaps today he's saying, yeah, they're just not.
If you looked at dollar yen this morning, you'd have no idea what happened in Japan overnight. In fact, if you looked at dollar yen over the last week, you'd have no idea there was a BOJ meeting where they're about to hike interest rates.
But wasn't this the goal of the Bank of Japan? To make it a symbolic move and not something that actually tightened any kind of monetary conditions? Because ultimately, they don't want to enter another lost decade of growth or lost 3 decades of growth. And that really is going to be their priority, regardless of what the rest of the world is doing.
If that was the objective, they've been successful. 150.52 on dollar yen. Let's turn to the US consumer. Liz Everett-Crisberg and the team at the Bank of America Institute seeing signs that the lower income spending growth is slowing. Their monthly report saying the following: this could partly reflect some loss of momentum at the lower end of the labor market. Higher income spending remains weak, but is stronger at the very top end. Just what is happening in the US with the US consumer? We can ask Liz right now. Liz, good morning to you.
Good morning. Thanks for being here.
Thank you for having us. We appreciate it. This quote from your work, I've read this 3, 4, 5 times now. Can I just share this with you? If you're just waking up, just listen to this. Monthly median value of savings and checking balances are more than 40% higher than 2019 for all income levels. You're looking across 69 million consumer and small business clients. That's not a typo, is it?
No,
40% up?
It's not a typo. And what, we've been working at the Bank of America Institute for 2 years looking at and leveraging the bank data to tell us real time what's happening. And this has been the statistic that has shocked me, but it's it's what we're seeing for the last 2 years. Everyone thought we were going to run out of money. The consumer was going to run out of money. And this year, the consumer has been very stable, keeping their checking and their savings deposits 40% higher than they were before the pandemic.
So that's not coming down, that's just remained stable.
It's coming down by tenths of a percent, but it's been around 40% higher for really the last 6+ months.
How much of a cushion is that for the US economy at a time where we're talking about rising delinquencies, maybe some credit card issues as well? How much of a cushion is that?
I think the cushion isn't necessarily on the savings side. The cushion has been in the labor market, particularly for the lower and the middle income consumer. So last month we saw, what we look at is the actual money coming into the accounts. So the after-tax wages and income getting deposited into the accounts. And we saw for lower income consumers that tick back up of 3.4% last month, which is the highest level it's been in almost a year. So when you see the labor market remaining strong, there isn't as much of the need to draw down onto that savings. Now, you mentioned before, you were talking about the difference between the higher income consumer and the lower income consumer. The big difference there, the higher income consumer is generally also participating in the markets, right? So even though their wage growth has actually been negative for quite some time, they've got the cushion of equity market performance.
Some people would say that sounds great. It sounds like everything is hunky-dory, but there's weakness under the surface, and just wait, hold on 1 second, and it comes in the form of leverage, it comes in the form of credit, and that we've seen credit card outstandings go up so much. We've seen buy now, pay later cushion, particularly younger households and their ability to spend. What do you say to that?
Well, I think, have we seen delinquencies move up? Yes, but not to an area that we're really particularly concerned about. The other thing that we look at is what's the ratio of spending that people are putting on their credit card relative to their debit card? That would be an indication that people don't. Those ratios are really essentially the same. But you talked about buy now, pay later, and buy now, pay later I think is really interesting to consider. When buy now, pay later first came out, it really did boost retail spending for the people who were using it. Really up 40+% relative to non-buy now, pay later users. But what's interesting is what's the population that's really using buy now, pay later? When we looked at our data last month, just under 9% of our customers made a payment to a buy now, pay later. So they had used it, just under 9%. That number is growing relative to last year, but at half the pace that it was. So is buy now, pay later really gonna be the boost if less than 10% of people are using it?
Nothing you're saying right now speaks to recession or weakness. Nothing you're saying right now speaks to anything that's close to a slowdown, a material slowdown in spending. Is there any historic corollary to this moment suddenly turning south really quickly with a labor market that still looks really good and people having that cushion?
We keep looking for that. We keep searching, and we're just not seeing it. Now, what I will say is, if we were talking a year ago, I would have said resilient, 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 resilient. I mean, there was nothing. What we're seeing now isn't recession on the horizon by any means, but the consumer is softer, but they're stable. They're softer and they're staying there, just like the deposit balances. They're stabilized at about 40% higher. Again, if we were having this conversation a year ago, lower income households' deposits were up 200%. So they've come down from that peak. They've spent, the stimulus, but they're stabilizing at that up 40%. Labor income continuing to increase.
Do you think there's space to lever up? Do you think there is space to lever up for the consumer? Because every time we see any signs of that, people start to get worried, like this is it, this is a tipping point. I just wonder, given everything you've said, it just sounds like we have space to do that in this economy.
I think everyone is looking for the consumer to roll over. And the advantage we have at the Institute is we're looking at the data as it's happening, and we're not seeing them roll over yet.
What about the small business clients as well? Is there a difference there?
Small businesses, you would think there might be. Small businesses are actually, again, they've been very resilient. They've been behaving very much like the consumer. I do think that they're softer. They're a little bit softer than they had been, but again, not rolling over. Small business was such an engine of growth through the pandemic and continues to be.
Is it across the board, or are there differences from sector to sector at the moment?
That is a great question, and I need to come back to you on that one.
I appreciate that. We can revisit this topic another time. I'm just trying to figure it out, because when we talk about how restrictive we are, a lot of people might point to large companies that can come to credit markets, issue tons of debt. We've seen all the supply through the start of 2024 taken down quite nicely. I just wonder if small businesses are having the same experience borrowing as their larger cohorts, their larger peers.
I think the small businesses are really behaving very much like the consumer is, and they're doing okay, and they're a great engine of growth. So we continue to love doing business with small business, but yeah, they're doing okay.
So just taking a step back as we reset, as Jay Powell wakes up in Washington, D.C. and prepares for his two-day meeting, what some of the fundamental structural shifts have been in the economy to allow people to have more cash in their balance, in their balances. And I wonder how much the housing market has to do with this. The fact that a lot of people used to save money that they would then put as a down payment to a house. That was the massive purchase. Does the fact that that's no longer as much on the table because there isn't the supply and it is so difficult to get into this market, is that one of the reasons why cash balances maybe are so persistently high when in the past they would be put towards something?
Well, I don't know that that's necessarily true, because I think, yes, you have people who aren't necessarily getting into the housing market right now because rates are what they are. They don't have, but at the same time, if you were in a house, you're not necessarily moving either. And I think if you look at rental prices, we have seen more recently rental prices in terms of what people are actually paying. So not necessarily what is being advertised as going up each month after month. But remember, if you're in a rental apartment, you're in there for the year. The rental prices seem to be okay. Now, are they investing, to your point, in the purchasing house? No, but where are they putting that money that they do have? They're putting it into the market. And remember what we talked about earlier with the highest income Americans.
Which brings us sort of full circle, and this is something that we were talking about in the past couple of weeks, how there's been this structural shift with retail investors accounting for a greater proportion of the overall investing base. How much is that a structural shift that materially changes the business of banking in some ways? Because all of a sudden, people have money, and instead of putting it into a house, they're putting it into the market, and they're looking for wealth managers.
Yeah. Well, that's a really good question. It's one we haven't looked at, and frankly, one we probably should consider looking at across the board from what people are doing in their consumer bank versus what they're doing and how they're investing.
So looking forward, what are you watching for to know whether this cycle truly is shifting or rolling over in any material way?
I focus on the labor market. I think the labor market is the driver of spending. The labor market is the driver of how people are able to engage. And if we continue to have a strong labor market, particularly on the lower end, I think we're going to continue to have a consumer that can engage.
Liz, your work is fascinating. Thanks for sharing it with us. Appreciate it.
Thanks for having me.
Liz Everett-Crispik there of the Bank of America Institute. Just to repeat that line again, because I'm told it's not a typo. Monthly median value of savings and checking balances are more than 40% higher than 2019 for all income levels. Isn't that amazing?
It's just defies what everyone has been saying would happen. This was supposed to be the year of the shrinking consumer balance sheet. It isn't happening. That has vast implications. This is the reason why people are looking for signs of weakness in the labor market, which also they're having a hard time finding. So again, it goes back to Mark Cabana's point. He set it up perfectly. Are bonds listening to the stock market? Because if they were, maybe yields should be a bit higher.
We'll return to that theme a little bit later. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Shanali Basak. Hey, Shanali.
Hey, John. U.S. lawmakers reached a handshake deal to fund the government through September 30th, and that's according to Bloomberg reporting. The agreement comes after the two sides resolved a dispute over the funding of the Department of Homeland Security. Lawmakers will now race to pass the agreement before a midnight deadline on Friday that would lead to a partial government shutdown. And Bitcoin continues its slide from an all-time high after a record daily outflow from the world's biggest ETF for the token. The $25 billion Grayscale Bitcoin Trust posted a $643 million outflow yesterday, the most since the ETF began trading on January 11. ETFs overall have attracted a net $12 billion, which helped propel Bitcoin to a peak of nearly $74,000. And NVIDIA CEO Jensen Huang has unveiled the company's successor to its AI processor. Speaking at the company's AI conference, Huang unveiled Blackwell, a processor he says is multiple times faster at handling the company's AI models.
The industry is being transformed, not just ours. Because the computer industry, the computer is the single most important instrument of society today. Fundamental transformations in computing affects every industry.
And John, that's your Bloomberg Brief.
Shanali, thank you, appreciate it. Up next on this program, the Fed's #1 priority.
The Fed's real focus is going to be what do they want to do with the overall setting of interest rate policy? How long do they want to keep rates at current levels? And how much restrictiveness are they comfortable exerting on the economy?
That conversation coming up next, live from New York City. This is Bloomberg.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Could face bigger challenges next.
It was going to keep Rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Stocks on the S&P 500 just a little bit softer here, pulling back by something like 0.1%. No drama whatsoever ahead of the Federal Reserve tomorrow. If you were looking for drama, maybe you were looking for Tokyo to do something. They did. If you're just joining us, the BOJ did actually hike interest rates. You'll be curious as to where dollar-yen is off the back of that, so I'll share that currency pair with you right now. 150, 53. Yen weakness. That currency pair breaking out by another 0.9%. It's an interest rate hike. Maybe that's all it is, Bramo, and nothing else.
They talked about weakness potentially from other economies in the region, China, and they're talking about the potential for that really keeping price pressures under control. The bottom line is nobody's really expecting this to be a rate hiking cycle, which is a reason why perhaps people aren't responding. I will say this, over from TD Securities saying that USD JPY is now hostage to the FOMC decision tomorrow. So now, Jay, is important.
This is going to take time. This doesn't just happen overnight. The Bank of Japan's going to just say, yes, okay, we worked on this for 17 years. Let's start hiking interest rates by 200 basis points overnight. This will take time. This is the first move of how many moves?
Well, maybe one.
I wonder. At the moment, it's the end of negative interest rates. We've said this a few times. It is not the end of easy money yet in Japan. It might be the beginning of the end of easy money. Under surveillance this morning, the Fed's #1 priority.
The Fed's real focus is going to be what do they want to do with the overall setting of interest rate policy? How long do they want to keep rates at current levels? And how much restrictiveness are they comfortable exerting on the economy? Those are the big questions that they have to ask right now. So the market, in our view, is right to focus its attention on the dot plot, keeping the balance sheet secondary, but slowing QT when they think about all the considerations around the balance sheet, that is indeed the #1 priority that they have.
Here's the latest this morning. The Fed rate decision due out at 2 p.m. Eastern tomorrow. The market implied odds of a June rate cut falling below 50%. Ahead of the decision, Bank of America upgrading the outlook for U.S. equities driven by an upgrade to small caps. The head of portfolio strategy, Marcy McGregor, anticipating some choppiness as cross currents emerge, including the Fed adjusting policy, the election and geopolitics. But overall, an upward trend. I'm pleased to say that Marcy joins us now for more. Marcy, good morning to you.
Good morning.
We caught up with Mark Caban, a different side of the business, I know, but he raised an interesting point, and I'd like to discuss it with you. Just how relevant are higher interest rates to this equity market at the moment, given how much we've repriced and how little equities have moved back?
I think interest rates are going to be really important here, especially for the small cap space. We recently upgraded. I think as long as interest rates stay reasonable, there's a lot of reasons small caps can shine. Valuation, historically cheap relative to their large peers. Big picture themes like reshoring, like infrastructure development, all would benefit small caps, but interest rates need to stay at a reasonable level, and that could lead to an extended period of small cap outperformance.
Define reasonable.
You know, our view is that interest rates likely move sideways from here. Obviously, the market's holding its breath a little bit ahead of the Fed tomorrow. I keep talking to clients about what matters to the market and what is just noise. And clearly, one of the two things I think that matters is the Fed. The other, of course, is earnings.
Well, okay, so just sticking with the Fed for a second, because at some point, Jay will be getting out of bed. You probably already have had out of bed, I will say, getting prepared for it. Well, I think that probably most people, especially, do you think he gets nervous?
6:50 in New York, I think it's like 4 a.m. in Washington,
okay,
D.C.
It's the same time zone. You know this.
2-3 hours
Come on.
behind us.
All right, moving on. There is this question about what he would say that could potentially make you reassess your thesis in small caps at a time when it just hasn't gotten off the mat. Everyone's been wanting small caps to rally, and it just hasn't been outperforming.
So when I think about what really matters from the Fed, it's going to be how clear is Powell's communication tomorrow? How transparent is he about policy? Clearly, we're going to hear a Fed that is likely on hold. It's going to be talking about a balance of risk, the risk of cutting too soon versus holding policy too tight for too long. I think he's going to try to take this really balanced view is my expectation, but transparency and why, the rationale for why they cut rates when they ultimately do. Are they recalibrating policy? Is it an adjustment? Or are they cutting rates because an economy is slowing? That's not our view. So I think the messaging is almost more important than whether it's June or July or, you know, what the exact timing is.
Well, at the moment, they appear to be pushing back the timing, or at least the market is, because growth is decent. We heard from Neil Dutter of Renmac yesterday. He wrote in, nominal GDP is pretty solid, which is a reason to like equities, not dislike them. You like the US over international. Why retain that home bias to America right now? Is it the rest of the world just not doing that well?
Well, if you look outside of the U.S., you know, here in the U.S., I think we see so much resiliency in earnings. We're starting to see this rotation under the index level. And I think that's really driven by earnings picking up in other sectors like discretionary, financials, industrials. And I think that's really important here to the U.S. story. But if you look outside of the U.S., you know, you have parts of Europe flirting with recession. You have China has been cautious in terms of their easing and stimulating the economy. I think there's just a more exciting story of resiliency and earnings growth. I think the earnings path may be slow in the U.S., but I think the trend is improving.
Let's go through the sector preferences. Energy, healthcare, discretionary, industrials. Can we start with energy and discretionary? How do those two things work with one another? We've got energy breaking out recently, Brent crude getting back close to $90 a barrel, energy equities picking up off the back of that. How do you reconcile the view on energy with the view on discretionary?
Yeah, absolutely. We've been adding cyclicality to our portfolio. So on one hand, we like energy. Energy's perked up a little with WTI over 80, right? But that's still a pretty reasonable level for oil prices. But it was good to see this sector respond. I like energy for a couple of reasons. One, it's inexpensive value-wise in terms of free cash flow and in terms of earnings. I also think it provides you a little bit of a way to position for a world where energy security is an issue, right? Red hot geopolitical world. We just heard from Liz on the consumer. We have a consumer that is largely stable. Our internal data shows the consumer is very much on 2 feet. Now we're seeing normalization in spending patterns, of course, still from the COVID era, but I think you have a strong labor market, and as strong as the labor market stays, the consumer will go with it, and I think that leaves an opportunity for discretionary.
That's the cyclicality. Let's deal with healthcare. Traditionally, that would sound super defensive, but as we know, healthcare is basically just a couple of names surfing the GLP-1 wave, and I'm trying to work out, when you suggest healthcare, are you saying GLP-1s, or are you saying more broadly there's something else happening here?
I think more broadly, right, it is that crossroads of innovation, right, and technology and healthcare and wellness and all of these things. But I also think healthcare gives me this nice mix of quality, some nice dividend payers, dividend growers, right? It gives me a little bit of a buffer of the ups and downs of growth, and it can withstand macro pressures. You know, you mentioned GDP. Atlanta Fed GDP now is showing some slowing, some moderation in growth. So while I think the economy stays strong, I think it comes off the boil that it had been on.
How much of the gains in some of these sectors are driven by NVIDIA? And I say this because yesterday there was this conference and they announced a bigger and better chip that cost $50,000, twice as much. And I just wonder, if you're going to leverage the gains in productivity in your portfolio, why not just 3 times lever NVIDIA shares?
Well, we already saw the Mag 7, the Magnificent 7 go to the Fabulous 4, the Fantastic 4, right? So you're seeing a broadening here, and I think that's going to be the story for the rest of the year. So yes, so much enthusiasm about artificial intelligence, but as we saw, it's about real demand. It's about the follow-through, and I think that's the story for 2024 is what's next for artificial intelligence. And I think there can be so many more beneficiaries, but I think value starts picking up from here. You know, 80% of the S&P is trading above their 200-day moving average. That gets me excited that this rotation may have legs.
What's the buffer asset class? Is it just cash or is it still bonds?
No, it's still bonds. So we recently upgraded equities, but it was a view of adding risk on the equity side and being really fully invested there, not a view about bonds. We still like high quality fixed income. We like treasuries. We like mortgages. We'd be slightly beyond benchmark duration here. Fixed income is providing real yields and diversification.
You said geopolitics concerns you. It doesn't sound like there's any geopolitics baked into here. Where does that come into play?
Industrials, defense, right? When I think about especially international defense spending, that's a little bit less of a U.S. story and more if we look at the rest of the world. I think defense budgets are going to be rising, and I think we're in the early innings of defense, and I'll also have to add cybersecurity in there.
Just to wrap things up and put a bow on it, Maryland Bank of America Private Bank, you don't think we should be 3 times levered NVIDIA, right? Just to clear that up. Is Bramo getting excited about big levered single name trades?
I mean, I'm just thinking to myself, this is actually what people were doing.
You're going to go to private bank clients, that's going to be the pitch.
Did you see what the options market was doing around NVIDIA?
Yeah, I know.
I mean, it was literally like, you know, the sort of penny stocks.
Alex Weber Bloomberg said this yesterday. It feels like the new Apple conference get-together product launch, right?
On steroids.
Amazing. Marcy, thank you. Good to see you. Thank you very much. Marcy McGregor of Maryland Bank of America Private Bank.
That was a no. They're not recommending.
No, I'm sure.
Leverage NVIDIA.
Clearly it was a no.
Well, I'm just letting you know.
Let's set up the next hour on Bloomberg TV. Coming up next, we'll be catching up with Brian Moynihan, the chairman and CEO of Bank of America. We'll also catch up with Candace Browning, the vice chair of the Bank of America Institute, and Wendy Stewart, the president of Bank of America Global Commercial Banking. That is a stacked 60 minutes here at Bank of America. Lisa, coming up.
Yeah, I'm really looking forward to it. I also really enjoy being in everybody's different homes where you hear the different noises and you kind of understand what their environment actually is.
What do you mean the different noises?
Well, the different beeps.
It's nice to hear the Bloomberg terminal.
But it was just.
I know that's the IP
sound.
beep.
I know, but it's enjoyable. It just
that.
makes me feel
that
like a pulse.
That is music to Mike's ears. Just that beep beep beep.
And yours too.
It's a beautiful thing. I love it as well. Sure, that's the alarm in the morning.
Exactly. Pump, pump, pump.
From New York City, the second hour of Bloomberg Surveillance. Up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Venture capital. It's been volatile. From bank Street prices anxiety to AI exuberance. Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
This rally since October has all been about big tech. The rally's definitely been broadening out a little bit, but very, very early days.
In terms of getting even more bullish, if you will, on the equity side, we're just going to have to see some broadening of breadth, if you will.
Put the Mag 7 aside. The other 493 earnings were down last year. We think they'll be up this year.
There is a broadening out that is happening in the market, and I do like the cyclical strength.
This is a pretty favorable operating environment for corporate America.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
I have to say, maybe it's just a coincidence that Brian just arrived and everything got very busy and loud very quickly. Just maybe it's just a coincidence.
He did point out that maybe some weren't in early enough, so maybe
they're all working hard.
Yeah, exactly.
I'm sure. From New York City this morning. Good morning. Good morning. The second hour of Bloomberg Surveillance begins right now with your equity market on the S&P 500 just a little bit softer this morning. The theme of the first hour right here at Bank of America's home in New York City. This economy is looking pretty resilient based on what we've heard so far.
I would put it this way: bull, 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 bull.
Yeah, kind of.
Bull, bull, bull.
Yeah.
I mean, it was just incredibly bullish in the sense that maybe things are not slowing down very much. I really do think that Mark Urbano summed it up when he said that maybe it's not stocks not listening to bonds, it's bonds not listening to stocks.
We've said this a few times. If you think about what we were priced for at the start of the year, we were talking about 6 rate cuts in 2024. Markets come down to 3. There's a risk tomorrow the Federal Reserve takes that median dot from 3 to 2. You've seen the front end of the yield curve reprice from around 4% back to 4.70. Equities, super calm. We've asked the question, so long as they remain calm and credit spreads remain tight, does that open the door for yields just to keep on pushing higher?
We've asked this question to people who actually lend to small businesses and said, right now, is it restrictive? Is it difficult for them to pay back interest rates where they are? The answer, no. Are you seeing credit stress as a result? No. Is it just survive until 25, or is this a new reality where margins are increased and actually inflation has been beneficial for businesses that can charge more and have bigger revenues?
We'll get into that new reality in just a moment. Let's start today, this hour, with some price action for you. Equity futures on the S&P 500, just a touch softer, a little bit negative on the S&P. We're down by something like 0.1%. You're probably interested in what's happening in foreign exchange, given the BOJ did hike interest rates for the first time since 2007. Who would have thought that that event itself would be a total snoozer? Yen weakness, not strength. Dollar yen breaking out by almost another full percentage point to 150.54.
On brand, that's all I'll say. It's completely on brand for the Bank of Japan in this particular moment where they are just trying to signal that they are done with negative rate policies. That doesn't mean it's a series of rate hikes that are coming at a time where they're still putting a priority on getting inflation up to 2%, not down to 2%.
Yep. Dollar strength, the story yesterday, on repeat again this morning. Through the next hour, here's the lineup for you. It's pretty special. Brian Moynihan, the chairman and CEO, on the outlook for the bank and the broader economy. Candice Browning, the head of global research, on the latest fund manager survey. And Wendy Stewart, the president of global commercial banking, on the unit's surge in new clients. We begin with our top story. The S&P 500 snapping a 3-day losing streak as investors begin to turn their attention from Jensen to Jay. And the Fed meeting starting today. Joining us now, I'm pleased to say, Brian Moynihan, CEO and chairman of Bank of America. Brian, we have to say thank you. Thanks for having us.
Oh, it's great for you to be here. These talented teammates are out working early in the morning and hopefully making some money for the shareholders.
It's getting noisy. We could talk about how much money they're making in just a moment. I actually wanted to start with a quote from Liz from the Bank of America Institute in the first hour of our coverage here. I find this stunning every time I read it. This will be the 5th time already today. Median value of savings and checking balances are more than 40% higher than 2019 for all income levels. As you look across the business, consumers, companies, just how resilient is this economy still?
Well, Liz and the team do a great job of putting this out, and we purposely created the Institute so we can get this data out. And it's not a reflection of what's coming tomorrow. It's more a reflection on what you see in the past. But it's very granular, 60+ million customers, 37 million checking account holders, and they have been remarkably resilient. And so the idea, if we were sitting here last year, this time we'd be talking about our team was predicting a recession somewhere early this year. It didn't. Then they took that off the table as we moved through the year, and now they're predicting 2% plus growth for this quarter. So you've gone from negative to slightly positive 2%. That is returning to the mean. It's not outsized growth. It's actually slowing down. So people can't forget we're going from a 4 to 5% growth rate to 2.5% growth rate is slowing down, and the restriction on the economy accomplishing its purpose. Meanwhile, the consumer is very resilient, and that's providing an anchor to windward that the Fed has latitude that a lot of places don't have, that they can be hold restrictive and let the economy really catch up. But they have to be mindful of the change. At some point, that consumer will slow down, and they have slowed down their spending. And so last year it had been 10% growth. This year, in the fall, 5%. Now it's down to 3 to 4%. And they've got to be careful they don't overshoot. So this is the tension we're in right now, which is this resilient economy, and actually, as you said, Lisa, actually trying to bring inflation down. Since the financial crisis to now, most central banks are trying to get inflation up. And so it's a completely different execution, and that's what we got to get right.
You're dominant in small business lending. Yeah. I'm just wondering just how much confidence there is out there still in corporate America at the lower level, in the small companies across this country.
If you say by virtue of their activity, it's strong. But on the other hand, line usage, and Wendy will be on here later, she'll talk about that. Line usage has come down a bit, which means that the cost of borrowing went up, and so therefore I'm a little more careful. And so hiring's a little more careful. Equipment purchase, a little more careful. And so, well, they're fine making money, and the profits are strong, and the team will talk about profits driving this market, and the EPS estimates for public companies. Even mid-sized companies are participating in that. The American economy is the dominant economy in the world right now in terms of activity and interest and investment, and lots of good trends for it. But on the other hand, why aren't they using our line so much? It's a little more costly, therefore you're a little more careful. And that's the tension we're going through. Everybody's trying to really figure out how this economy will perform. And 4 months ago, people were worried about a recession. 6 months ago, worried about a recession. Now they're not. But now the question is, do they really want to invest heavily in it? And that's where you're seeing a little bit of tension here. So everything's fine, solid, resilient, all the words you wanted to. But it has to sort of work the next twist in the economy to get back to normal.
It's funny, I hear some of the people who work for you, and they sound incredibly bullish. Nothing's wrong, whatever. Is it your job to basically look around corners and see what potentially could be the problem, but otherwise things are screaming, and it suggests that even 4.5% 10-year rates would be just fine for the lending and the activity that you're seeing?
Well, I think we're also adjusting as a company and as an industry and as a society to a simple thing that from 2007 or 8 till 17, you had no interest rate. Then you had interest rate for about 24 to 36 months. Then they were dropping rates in 2019. Then the COVID comes and they drop. So we've never really had a normal interest rate environment. You know, what would have typically been a 3% front end rate, 4 to 4.5% back end rate, a normal sloping curve, real interest rate. It hasn't occurred for anybody under 40. You know, they literally weren't working back then. So, that sounds curmudgeonly, but the reality is that's true. So everybody's adjusting this. So these high rates at 4.5% in the 10-year are not high rates in the grand scheme of things. They're high rates in the last 15 years. So we got to adjust to that, and that'll take time to work through the systems and models and thought process. Our team is the best team in the world in research, and you're going to hear from a lot of them today, and your viewers will benefit. On the other hand, you know, as you look at it more broadly, my job and the team's job at the top of the house is to make sure we're balanced for all outcomes, and that's why we're always worried about what happens tomorrow, and we plan for it.
The balance in outcomes is leading to some really frustrated and bored traders, and we talk about that with a lot of people who basically say there's not a lot to do because you can't really get an edge. Are you seeing that in trading activity? Are you seeing that in trading revenues as people basically have no incentive other than just to hold NVIDIA, hold on to, you know, some of the credit that keeps on rallying and just, you know, make bank?
Well, our team has just come off of last year, a record amount of revenues in the quarters, a record in growing quarter over quarter, and we think they're going to fare well this quarter. We told the market that a few weeks ago. And so Jimmy DeMar and the team that's out here, the research team under Candace and the investment banking team under Matthew are driving the business and actually gaining share. And so while, you know, pools are down in investment banking, we've gained some share there. While pools are stable, flattish, we're actually up, and that's different in this business. And they do it with the right risk. They made money, I think, every trading day last year, nearly every trading day for the last 5 years. And so they do it the right way. Is that boring or not? You have to ask them. It's just fine with us because at the end of the day, that recurring capability, that ability to keep delivering for clients and doing what they need to do and make money at it and deliver for the shareholders and get a return on capital is what Jim and the team have done a great job.
You alluded to it. Have you maintained that momentum from that record fourth quarter?
Yeah, we think we're this quarter start off well. The team's doing a good job, and you know, when you get to be bigger and bigger, it's hard to keep that growth going. They keep doing it.
Can we talk about the M&A slump as well? Are we working our way out of that? We wake up every single morning, we've got a new big blockbuster deal, and then we have a conversation about whether they can actually close it or not because of antitrust concerns down in Washington, D.C. Do you find us exiting that slump this year? Is that what you're looking for?
I think until there's a clarity on policy, that question is going to come up every time a deal's announced. So the companies are actively engaging in a dialogue, trying to figure out the strategic moves, and then the question is, can they get the deals through? And that happens in all industries. We need to get this resolved. We need to get to a more rational, predictive outcome to have, you know, people willing to take the risk of putting their company at risk for a sell side, and that's really what it comes down to. The buyers, you know, put themselves somewhat at risk. The sellers really put themselves at risk because a company, hanging in abeyance for a longer period of time is a tough place to be. Having been there before in my life and having caused people to be there a lot in my life, you know, it's a tough place. And so how to run the company, what you can do. So I think we need to get a faster turnaround. The idea is these transactions don't change this month or a year from now. They're the same transaction. People need to get after them, look at them, decide what they're going to do, and give clarity so that the market take place. The good news is, you know, investment banking revenues have stabilized and moved back up, and that's good. But the M&A piece is still the piece that could come on and push through.
Do you find that some clients are reluctant to make deals based on what you just
100%.
said? Even though they make business sense, they just don't even want to entertain the conversation?
Because the risk-reward balance is so tough. Not everybody has the staying power to fight through, you know, lawsuits and time and effort and things like that. And so it really requires if you said you needed 10 points of strategic import out of 10 to do it 10 possible points, you might need 7 before. Now you need all 10 because you really have to say this is worth hanging on to and fighting through. That's a different environment. Now, against that, you are seeing deals announced, and that's because they make strategic, compelling sense for that buyer, seller, et cetera. But you know, it's just been slowing things down. And I think as there gets a rationality here and around the world, because remember, none of these deals are simple anymore. For any company, they have operations in Europe where there's same sets of approvals or different sets of approvals and operations in other environments. But yeah, at the end of the day, consolidation comes because of strategic import, and I think you have to let capitalism run.
So let's just talk about some of the policy shifts, which is nice, gentle allusion to the election later on. Potentially, they could offer some more certainty. What kind of M&A boom could you see after that certainty has been established?
Yeah, we'll see. I mean, I think, elections are elections. This company, the oldest part, has been around since 1784. And, there's been a lot of elections since that time frame. And, we have to adjust. People, I think you guys asked me in Davos, do you have a drawer for one outcome, a drawer for... The answer is no. We just run the company and drive it. So, I think certainly around the election process here and around the world, we'll add to, okay, we know what we're dealing with and go on. And so that'll create some energy. But I think we have to be careful to say one thing leans one way, one thing leans like, because frankly, the politicians have to get this right for the good of their own state economy, country economies and stuff. And I think they're all struggling with it.
So we talk to a lot of strategists, political policy strategists, and they all say no one can really quite believe that it's Trump versus Biden again. And so they're trying to figure out who it's really going to be. Is it going to be you?
Me what?
Running for office. I mean, this is sort of what people are talking about. They're talking about Jimmy and I mean, this is sort of something that comes up in your discussions.
No, I've got a great job here.
I had a feeling you wouldn't put your hand up to be Treasury Secretary in front of the team this morning.
I know, right? You want to make
I've
sure
got a great job. At the end of the day, our job, my colleagues that are in the leadership across all industries, is to help any administration be successful, and that's what we try to do here and around the world. And and those are tough jobs, and but I don't think I'm running for office, so I think I've got a great job here, and I've got to continue to do it and try to help this team and everybody be better than we could be tomorrow than we are today.
There's been some fires to put out over the last 12 months in the industry. It's been a year since SVB failed. NYCB has been a new issue. Seems like last year was a rate shock, and this year just big worries about maybe a credit shock. Have you noticed any deposit flight coming towards you from regional banks in any way, shape, or form similar to what we saw 12 months ago?
There hasn't been the kind of change there was last year, because there are unique business models. That's what's not involved. There's a little bit of it, and so nothing we're seeing. And by the way, we see a lot of flows, and we don't see it anywhere. The industry is well capitalized, has good liquidity. Believe me, from last year to this year, people shored up their liquidity across the industry. Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession. And so there'll be difficulties, and we're working at. But, the trading attitude, which is these assets got to move at a price tomorrow morning, isn't the way the banking system works. And frankly, that's the value of the banking system. We work with clients. We figure out what you take a building, you figure out what the ultimate end state rental rolls will provide. You refinance it. Sometimes that wipes out the equity. Sometimes it doesn't. We're careful in how we underwrite as an industry. The top 30 banks go through the stress test, which has an effect that says, wait a second, if you're underwriting out in an odd way, you have to put up the capital to prove you're right before you even get the chance to prove you're right. So in other words, your capital requirements will reflect your underwriting today, even though recession may never come. And it reflects your underwriting commitments under a scenario where commercial real estate drops by 30 or 40% instantaneously. So there's an effect on that on the industry, which is much more conservative building and much more middle-of-the-road building, which is probably slow down the capital provision to some of these companies. But on the other hand, it's not a bad thing when you get to this point. So we feel very good. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
When we caught up in Switzerland, we were talking about the prospect of a change in capital reserve rules. Chairman Powell in his semi-annual testimony appeared to back away from that. What was your reaction to what Chairman Powell had to say in the last couple of weeks?
Well, we in the industry and we at Bank of America believe that we have tremendous amounts of capital, liquidity. It's tested, the stress test. We don't need to keep moving the rules around. We're clear about that. And so, I think as people look at this, they're saying sort of what's the reason? In the end of the day, U.S. banking system and the U.S. economy are coexist with each other, and the U.S. economy has grown from pre-financial crisis now. The European economy has grown a lot less. The U.S. economy is much more vibrant. It's recovered from the pandemic shock faster. It's absorbed some of the things. And everybody says, well, that's because X, Y, or Z. But the reality is it's because the kind of capitalism practice in the country is good, and the kind of banking system, financial system more broadly helps that happen. And so, we've weathered storms. Just think since early 2000, we've had a pandemic, recovery from the pandemic, the fastest rise in interest rates, 2 kinetic wars on the ground, trade debates around the world, shipping restrictions. You go through all this. In the end of the day, this industry, we made $100 billion after tax from 2020 through now. And we built huge reserves, we took them back, we dealt with the pandemic, $70 billion of borrowing overnight, a flood of deposits, some of those deposits come out. That's the resilience of the system, and that's why we got to be careful about adding capital and stuff when the perceived risk we don't think justifies it.
In the meantime, there has been a shift in terms of consolidation of market share in some of the bigger players. And you were talking about how you were gaining market share. Who are you mostly gaining market share from? Is it the smaller banks? Is it from Europe? Where in particular?
Each of our businesses, our 8 lines of business, have different places they gain from. And so when it's the investment banking and with Matthew Coder and the trading team under Jimmy, that's largely coming from the long tail people. This business is hard. It requires about $1 billion of technology investment a year to have a trading platform to keep up with it. So think about that. Wow. So when it's that hard, that means people who don't get the returns on capital have quit, and it's come this way. That's very different from the consumer bank, where Dean Athanasia and Holly O'Neill and Aaron Levine that run that business for us have just been driving core account growth. And so, they give you the statistics about constant accounts. We've grown our consumer base probably 4 million core checking accounts since the pandemic. So the deposits are up because of those extra balances. That's coming from everywhere. So it really comes from different places, but the idea is our job is to win the market and take it from every place.
When you talk about the investment in technology, how much is that going to be an ongoing benefit to a bank like yours that can invest in some of the artificial intelligence that we're hearing about every day?
So I think if you think about, we got to be careful about artificial intelligence versus machine learning versus digitization versus digital practice, because it's all different things. But let me just give the simple stats. In 2010, we had 100,000 people in our consumer business. Today, we have 60. We had 6,000 branches at the high point about 2008. We have about 4,000 now. We had about 400 billion deposits. Now we have 900 billion. The amount of transactions going through is light years bigger, and we're doing it with 40,000 less people. And the expense base we run the whole company on today, nominal expenses of $64 billion, round numbers, is the same we ran it on 2015. That is all the stuff you're talking about. That's applying technology over and over and over again. And are we perfect? Absolutely not. Do we have room to keep applying? Yes. Is there plenty ahead of us? It's unbelievable. And so if you look ahead, we're basically running on neutral headcount. And everybody says, well, you're not hiring. We're hiring people in businesses and putting revenue generation capabilities out there. At the same time, we're taking it out of the expense base. And that's a constant strain. And it's pretty remarkable what you can do. But if there was some way you snap your fingers and change the whole thing, you would have done it. I mean, we're not.
What you just said, though, is so important. And can we finish there? I was going to jokingly ask you whether we'll all be replaced by a big supercomputer in the next 5 to 10 years, and I think a lot of the people behind us would like to know the answer to that question as well. But I guess effectively in the next 5 to 10 years, are we effectively saying that each additional dollar of revenue is going to be less and less labor intensive because of this adoption of technology?
We had 300,000 people. We have 212,000 today. It's going to have less labor content. Are those people paid more? A lot more, because the way the labor content shifts. And so if you think about it, it will have less labor content because that is the expensive part, but it'll have more value added from labor because that's the way the mathematics will work. And so as you think about these trends, they're inexorable. They just keep going on. But people are forgetting these trends are already going on. And so one person's AI is another person's algorithm models that traders have been using for years. One person's AI is another person's Erica, which is 18 million customers using it, every day type of thing. And so you got to be careful about it. Is there potential here that we've never seen before? 110%. But the real question is, you don't have to wait for that potential. You're taking it out every day if you're working at it.
No 3-day week coming to Bank of America anytime soon? Is it Jamie who said that? 3-day week?
I'm not sure I understand the math there, but our team does a good job. They want to work 5 days.
I'm sure they do. They're nodding away. Yep. Brian, it's good to see you. Thanks for having us. We appreciate it. Brian Moynihan there, the chairman and CEO of Bank of America. Equities right now on the S&P 500, a touch softer, a big week ahead of us. Up next on this program, NVIDIA unveiling Blackwell.
This is Hopper. Hopper changed the world.
This is Blackwell.
That conversation up next.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Live from New York City this morning. Good morning. Just a flavour of the price action for you, starting with the S&P 500. Equities a little softer this morning. No real drama. We're negative by what? 0.4%. Losses build just a touch here, Bramo. Not much to talk about. Basically, in the equity market, we've been okay for the last couple of weeks, even with this big repricing we've seen in the Treasury market.
We had 2 straight weeks of losses. It sounds scary. It's less than 1% both weeks combined. We basically gained it back in a couple of hours. The key question for me is what's going to ultimately shake the conviction that this market has, that there is ultimately strength, there's ultimately promise, and we seem to be in a market that wants to rally.
We need to talk about NVIDIA just a little bit. Under surveillance this morning, NVIDIA announcing its newest AI processor, the follow-up to its signature product that fueled NVIDIA's explosive sales and sent its valuation soaring. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, it felt, let's just call it Steve Jobs-esque yesterday. How much of that was a repeat of what we used to see from Apple?
Yeah, look, their product cadence continues to be improving, and they had everything in there in terms of, focusing on LLMs, training, inferencing, announcing a lot of partnerships. Almost every tech company, it seems, is partnering with NVIDIA. So clearly, every 12 months, they're going to come up with new architecture, and that bodes well for their moat. I think the competitors like AMD and Intel will find it hard to catch up at this pace.
Why then, Mandeep, why are the shares down today?
Well, so it's an expectations game. I mean, back, 6 months back, expectations weren't for them to do $100 billion in data center sales. So clearly the bar keeps going higher and higher. And at this valuation, over $2 trillion, we could argue stock is not going to 2x from here, regardless of what they do. And this is a cyclical industry. So they will run into that CapEx cycle, cyclical slowdown. That will happen, whether it's 6 months from now, 12 months from now. And that's why valuations, multiple expansion is very unlikely from this point on.
This is what Alex Webb told us yesterday, Bramo, when he was talking about this event, anticipating it, that maybe it would be a Southern News event in the same way that the Apple events used to be under, say, Steve Jobs launching a new iPhone.
Because there just was so much hype. That said, in the options market, I have to say, I am fascinated by the options market right now because it just is full of people who want
the bullishness.
The bullishness. There were people betting that the share prices would double that you'd basically have double the valuation.
Right, in a short period of time as well.
It's
I know,
just
it's
quite,
crazy.
Yeah.
Up next on this program, and Mandeep, thank you. We'll be catching up with Candice Browning, the head of global research at Bank of America, on the latest Fund Manager Survey.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Top tip, if you're bullish about anything, pay to bring Bramo round to the office and she will talk you out of absolutely anything.
Okay.
Anything you're constructive about.
You know what?
Possibly happy about doing.
You're projecting. I think that you would do the same. If I were not here, you would do the same thing.
I'm just not as bad as you. That's all.
You're more subtle, but carry on.
From the home of Bank of America in New York City, good morning to you. Caught up with Brian Moynihan in the last 30 minutes or so, the CEO and chairman. I have to say, my takeaway from that conversation around mergers and acquisitions, the amount of companies, clients that would possibly entertain a deal that don't want to entertain a deal because they'd be hanging around for so long waiting to see if DC would approve it. That's a problem.
Particularly if they're of a certain size, which makes me wonder, if you think about companies that have cash and they want to make a purchase, all the smaller companies that are suddenly really attractive acquisition targets because that won't get caught up in some of the antitrust and other kinds of regulatory issues.
We'll return to that theme in just a moment. Let's start with the price action for you. Beginning with equities, we'll work our way to bonds and finish on foreign exchange. In the equity market on the S&P 500, pulling back just a touch, we're negative by 0.4%. We snapped a 3-day losing streak on the S&P in yesterday's session. Pretty decent day, actually. Pretty much every single sector on the S&P 500 positive by the time we got to the close. On the Nasdaq, we are negative by 0.6%. I want to turn to the bond market. Already heard from Mark Cabana of Bank of America this morning about the prospect of yield to the long end drifting even higher. Here we are at 432.63, nowhere near the highs of last year. But the fact of the matter is, we came into this year and consensus was, and consensus still is, that yields are going to be lower by the end of the year. The front end of the curve pushing back against that and pushing back against that hard. We've gone from 4.1% to 4.70 in just a couple of months.
Remember when people were calling for 7 rate cuts this year?
I know.
Remember when that was sort of a base case, and it basically was this assumption that the Fed was just putting 3 rate cuts out there because they just wanted to basically sandbag the market before they really started cutting aggressively. This, to me, is one of the biggest surprises, and Mark Cabana nailed it when he said, you know, ultimately, is it bonds that have to catch up to stocks? Are stocks sending a very strong signal that people just aren't listening to?
That the economy is okay, and we'll talk about that economy in just a moment, because basically what we're seeing from fund managers is that this economy is better than okay. I want to finish on foreign exchange and talk about the Japanese yen. Dollar yen. Is this the 6th day of yen weakness?
Yep.
I think it is. 150.44. Positive by 0.9% on that currency pair. That is a weaker Japanese yen in the face of the first hike in 17 years.
Which just shows how you can get the direction right and get the trade so wrong. Because if you take a look at the rhetoric that we heard from the Bank of Japan, it was, here you go, we're doing what you asked us to do. We're going to also remove yield curve control. Sounds really hawkish. We're very concerned about economic weakness. We don't know whether this price pressure can handle it, it can subsist. We don't know about what's going to happen with China. And all of a sudden, the yen, just, you know, that was the sound of it.
You have to compare and contrast. That was beautiful, by the way. You have to compare and contrast the start of the rate hiking cycle at the Federal Reserve. Compare it to the start of the rate hiking cycle, if this is one, at the BOJ. The BOJ wanted disinflation. They'd been fighting for it. It was a once-in-a-generation opportunity to reset inflation expectations higher. The Federal Reserve did not want this inflation. So that's why you're getting very, very different communication off the back of the first hike from the BOJ compared to, say, the Federal Reserve and the ECB.
I do wonder 2 things, whether this is turbocharging equities in Japan, because now it's even more of a discount, right, for people who are buying internationally. But second of all, if the Bank of Japan gets nervous, if, say, the Fed is more hawkish, what that does to the weakness in the yen, and whether that becomes a problem in terms of bad inflation that's imported from outside.
Dollar yen, a clean break at 150.43, up by 0.9%. Let's turn to that survey. Bank of America's latest fund manager survey showing risk appetite at the highest level since November 2021, and investors rotating into Europe and emerging markets at the expense of US tech. The brilliant Candice Browning, the head of global research at Bank of America, joins us around the table. Candice, good morning to you.
Good morning, John. How are you today?
Wonderful. Thank you very much for hosting us. I want to talk about the highlights of the latest survey. Just bullish, bullish, bullish. Global growth expectations, 2-year high. Risk appetite, the highest since November 21. EPS optimism, 2-year high. How does this one stack up to the one we had last month, the previous month, the month before that?
Well, everything has ticked up a little bit across the board. Even some sentiment regarding China, although people are still very negative about China overall and think it's kind of in a secular decline as it relates to the markets. But what I think is really interesting about this fund manager survey is what you said, and the title of it is Bulls Go Global. So basically what this fund manager survey is showing is that expectations around growth and the performance of equities is expanding outside of technology and outside of the U.S. and into the rest of the world. And that's why this fund manager survey is different than the prior months.
Can we get into that growth optimism then? Are we saying it's not just the United States? We're hoping for better growth out of Europe, out of China, out of Asia?
Yes. That's exactly what we're saying. And in fact, we have a proprietary indicator called the Global Wave, which is different than the fund manager survey because the Global Wave is an amalgamation of just economic data. So things like industrial production, consumer confidence, earnings revision ratios, things like that. So it's just facts amalgamated all together. And that Global Wave troughed in January of 2024. Now, statistically, after the Global Wave troughs, emerging markets perform the best, and on average, they're up about 19% in the 12 months following the trough. The U.S. does well, too. Japan does well. Asia does well. The U.S. just does a little less well than all of the other areas. So yes, it's this broadening out of growth.
I wonder how predictive some of these fund managers' feelings are. This is sort of one of the key questions when I get this is this a contrarian indicator? If everyone's going bullish and it's going global, is this something that, we should get concerned about, or is this a forward-leading indicator?
It's a great question, and we do have an indicator called the bull-bear indicator, and when it's above, I think the number is 8, that is a contrarian indicator because people are too bullish, right? Right now, that indicator is around 6.5. So we're not in that extreme bullishness area yet at all.
With all of these indicators that you are sort of putting out there, and I've got to say, I find it interesting, is there a competition between the surveys? Do the different units that run their own surveys sort of say, mine's more predictive than your survey a little bit?
A competition, internal competition can be a good thing.
So that's a yes. There's a lot of, crap talking each other. But I am wondering about, what you find the most reliable kind of North Star at a time when we're looking for what can have predictive value in a very messy data environment?
It is a very messy data environment, and I try to look at these as a mosaic rather than have one North Star. We have 84 of these predictive indicators, and the bulk of them have been rising since 2022. We've seen a real breakout in a number of them, particularly the industrial indicator. The semiconductor memory indicator is at a 7-year high, and that's very important because we all know semiconductor cycle, leads the global economy statistically. And then we've got an indicator which looks at digital advertising. That's a relatively new one, and that one has also been breaking out, and that's good for consumer and service economy, particularly in the U.S. So you've got industrial indicators, tech indicators, and consumer indicators all breaking out, which fits with the global wave and what the fund manager survey was saying.
Can you help me understand sentiment? Sometimes on this program, it just feels like this, Everyone that comes on is bullish, sentiment's pretty solid, maybe on the edge of euphoric. I think we'll catch up with Savita Subramanian in about 20 minutes' time, and she'll tell us that this market is not euphoric. How do you gauge sentiment? Of those 84 proprietary indicators, how do you gauge that?
Well, the sentiment indicator, the main sentiment indicator really is this global fund manager survey. That's a sentiment indicator. The global wave is just pure economic data. And that contrarian indicator that I was talking about before, the bull-bear indicator, would indicate that sentiment is bullish, but it's not extremely bullish yet. It's not euphoric.
Are we benchmarking to extreme times like 1999? Is that what we're benchmarking to?
Yeah, I mean, this data for the fund manager survey goes all the way back to 1994. So,
wow.
Yeah, long time. And as a matter of fact, the jump in the allocation to EM was its highest since 2017. That's a big jump.
Honestly, I'm glad that you asked that because you started talking about it's not euphoric. It's optimistic. It's pretty bullish, but it's not euphoric. I mean, divine euphoria. Everyone who comes on is basically talking about how incredible everything looks and how surprising and strong it looks.
Yeah.
You start to wonder.
It's a question I often ask, Candice, just how valuable is it to benchmark to an extreme? To say that it's not 1999 doesn't necessarily mean it's good.
Right.
Is it useful?
I think look, history does not repeat itself, but you can learn from history. So I think having these indicators and having these benchmarks and looking at prior times is very healthy. But the world forward will be it will look different.
So let's talk about sort of the third rail right now, or perhaps the first rail for certain executives, which is the use of machine learning and AI in some of these indicators. How much are you actually deploying the ability to sort of take data points from data sets that you have, put them together, stick them through a machine, and get a response, bull, bear?
That's exactly what we're trying to do with these indicators. And we use, we use machine learning, we use all different techniques, and most of them are aggregates. We never would have been able to do these indicators 5-10 years ago. We didn't have the capability of aggregating all this data together. And I think you're going to see more and more of this done across markets. And what I think it means is we're going to get better and better real-time information. I mean, you heard Liz talking about the Institute. We're looking at 69 million accounts. That's a lot of data. That's not sending somebody a survey in the mail and getting them to respond. real-time data on 69 million accounts. And I think this is a wonderful thing about AI, and I think it will allow policymakers to respond more quickly to better information.
Can we finish up by talking about the future of global research and what it's going to look like in 5 to 10 years' time? We spend so much time in this program talking about a shift away from public markets to private markets, a move away from single names to passive index investing over the last 10 years. Is the nature of what you do changing as well? Do you move away from single name coverage towards something else? What's this going to look like?
Yeah, you know, we've been dealing with that issue for a very long time, and one of the things we've tried to do is to change the types of research that we're doing. So I'll give you a great example. ETFs. We cover more than 400 ETFs. You know, people think all ETFs are the same. If you buy a sector in ETF, the bank sector, you're going to get the same performance. You don't. There are dramatic differences. So the ETF research, you know, stuff on passive, we're changing the kinds of things that we're focusing on. But at the end of the day, we still need to do the basic single stock and single security to build up to those broader, you know, passive securities.
So if you're at college right now thinking about a future, there's a future for them still?
Absolutely. You know, research is a great job. You know why? Because you get paid every day to come in and think. How great a job is that?
And you get paid more than academics to do the same thing.
It's actually
beautiful
true.
thing.
You know, I'm just thinking about Woody Allen and like The Sleeper, and you have a machine being like, you know, put in your data points and then spitting out, bye.
I'm pleased they picked you up on a single shot there of that robot impression. Candice, we're going to leave it there. It's great to catch up. It's good to see you.
Thank you so much.
Thanks
Great
for hosting
to
us.
see
Thank
you.
Candice Browning there of Bank of America. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. We can catch up with Shonali Basak. Hey, Shonali.
Good morning, John. The Reserve Bank of Australia has signaled that it's finished hiking rates, and it sparked a sell-off in the nation's currency. The central bank kept its policy on hold for a third straight meeting and made no reference to further increases to rates that already sit at a 12-year high. And Reserve Bank Governor Michelle Bullock said they need more confidence in the downward trajectory of inflation before considering rate cuts. The current forecast is for a return to target in late 2025. And Secretary of State Antony Blinken will make his 6th visit to the Middle East since the Israel-Hamas war broke out, making stops in Saudi Arabia and Egypt. The visit comes at a time of increased tension between the U.S. and Israel over the situation in Gaza, with Senate Majority Leader Chuck Schumer and Israel Prime Minister Benjamin Netanyahu exchanging verbal blows in recent days. And Hong Kong has fast-tracked a measure further cementing China's control over the global financial hub. The approval of Article 23 completes a 2-decade campaign to pass local legislation protecting the Chinese state. New crimes such as treason and insurrection carry life sentences. The measure already broadcasts defines state secret offenses in line with China's vague legislation around espionage. The move raises questions over the city's status as an investment and tourist destination. And John, that's your Bloomberg Brief.
Shonali, thank you. Up next on this program, commercial real estate in focus.
Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession. And so there'll be difficulties in reworking that.
That conversation up next, live from New York City. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had in.